Right to flag that we should watch the aviation sector. Travel and leisure is the worst performing sector this morning and very much does have a tendency to move with the oil price if the oil price move is sufficient, is substantial enough. And we do see some of those aviation names looking a little bit weaker this morning.
We also have the ones that are on the receiving end of potential retaliation from the US over the digital taxes. So I've got SAP open here up down 0.5%. Capgemini down 0.7%. But Publicis, we were expecting a hit. They're up 0.25% this morning. So not so worried by the USTR.
Yes. So we'll wait to see what comes of that particular threat, perhaps. Let's move on to the gilt market then, because we've been watching what was going on here because of the dynamics around the inflation print this morning. And actually, as expected, we're seeing gilt yields coming down, in particular at the short end. Well, actually, no, it's quite consistent across the curve, but at the short end, we do see the 2-year yield down by 7 basis points. That's pretty consistent across the everything out to the 10-year tenor, and then, yes, even beyond 50-year, down by 7 basis points as well. So we can see quite a lot of rethinking of just what the rate profile will look like in the UK next year, perhaps. Let's broaden our conversation this morning and talk about these markets with Maria Weitmaner, who joins us, Head of Equity Research over at State Street Global Markets. Maria, very nice to see you. Thank you for joining us this December to talk about where we are in markets now and perhaps a little about 2026. I want to start there. Your expectations for 2026, just how good do you think it'll be for stocks?
Yeah, good morning, and thanks for having me. I think when we're kind of looking ahead to the next year, we kind of think about the drivers that provided us with a very strong support for stocks this year, and it was okay corporate profits. That was a good support, and normalization of monetary policy, and particularly in the US. And I think we're still in that world where corporate earnings are being strong. We see positive earnings revisions overall, and policy is normalizing. So I think that at least like in the foreseeable future, before events start hitting us, we're very constructive on outlook for next year.
You're very constructive for next year. And let's talk tech then, Maria, because you're always such a supporter of tech and you're always a big fan of tech stocks. Now, you say in your notes that there is still no alternative, and I'm sure you'll have reason for that. But just to throw a little counter at that argument, I've got a chart here that shows the S&P.
She's done her homework, Maria.
Well, I'm sure Maria will have an answer, which is why I'm doing this. S&P 500, most recent part of 2020. I've got the fourth quarter basically on this chart, which shows the S&P 500 and what's happened to tech stocks. And actually, it's been healthcare and banks that have been doing really well of late. And so I wonder, is it still right to make that argument that there is no alternative to tech stocks?
Yeah, okay. So there are two parts to this argument. First, I do believe that tech is probably going to lead next year, but healthcare is another very interesting conversation we can have. Starting with tech sector, the reason we love tech is, we still strongly believe that earnings growth would be the key driver of relative performance in the market. We still think that sectors and styles and countries where earnings growth is stronger than somewhere else will continue to kind of garner investor support. That was true for the last couple of years. Yes, it drove valuation to kind of very high levels. And you can have like this wonderful chart of looking at earnings expectation versus valuation. And yes, tech is expensive, but it's the one sector that expected to grow very, very fast. Everything else is trading at a discount because earnings growth is slow. And I think we still not seeing that dynamic changing. So that's kind of your case for tech. I think healthcare is really, really interesting. Up until kind of start of summer, it was the biggest underweight institutional investors had in our custodial database. Investors were really, really negative on the sector. And there are lots of fundamental challenges with the sector, but it was a huge regulatory risk. And it's beginning to change. And we saw very strong investor buying, and absolutely correct. That was the best performing sector in Q4. What we're seeing a lot of it is position adjustment. So you start with a huge underweight, prices start to go up with a little bit more M&A activity happening in the sector. We see a little bit more. I mean, you just mentioned some more drug kind of permissioning in US happening. So prices start to go up, and people who are underweight the sector, which we know it's a huge position, they begin to buy. Price goes up, they begin to buy. So it creates its own momentum, and we're still in a very, very underweight territory for sector holding. So yes, healthcare looks an interesting sector for us. Not so much that fundamentals really improve, but it's creates this kind of position unwind and kind of short squeeze in the sector. So we're still there.
But Maria, what is your answer to those who question when the capex into AI is going to translate into productivity gains and big juicy returns?
Yeah, no, that's a kind of not even $1 million, $1 trillion question. And I mean, I think what's important for investor is that who would be the beneficiary of this capex? I mean, we hope this new technology is transformational and it's multi-decade improvement in productivity kind of going forward. But in the medium term and short term, who benefits? And for now, it's really the people who kind of, picks and shovels, the kind of infrastructure build up. That's those companies already benefiting. Think of kind of NVIDIAs of this world or Microsofts or Googles of this world, people who provide infrastructure for AI. So for them, the path to monetization is much clearer, much easier, much more transparent. And those companies, in our view, that's easier case to make in terms of monetization. What will happen later on, I think we still need to technology needs to develop and their kind of case needs to be proven. But those mega cap companies that are doing majority of investments, for them, the monetization case is a lot clearer, and that's what they're kind of trading in.
But surely the bigger question is who loses, whose capex is wasted, and what are the biggest risks to this positive view, Maria, in 2026?
Yeah, I think it's an interesting point, and I think lots of people talk about, and I mean, we even hear from kind of central bank officials that, it's quite a big risk to labor market, lots of jobs will be lost. I'm being an equity analyst, so I'm trying to have a more positive spin on it. I don't think we'll lose people doing the jobs. I think the people will become more productive, and with the same labor force, companies can do a lot more, so that's kind of margin enhancing and profit enhancing. So, I mean, we're already seeing that all of us kind of becoming a little bit more efficient. We kind of reduce the number of kind of boring and manual jobs we need to do in kind of our job. So becoming more productive and coming up with kind of more efficient way of doing things. So I think that's the direction of travel. It's not like we need less people. We just be more efficient, more productive. So that's kind of my positive spin on tech capex.
Yes, let's hope we all get to do less boring jobs, Maria, as a result of this, rather than less work entirely, which is perhaps the conversation that is ongoing, and we'll see where it goes. Let me ask you about value stocks then, Maria, because clearly you're all about tech still. Do you see anything shifting there? Is there any AI dimension to some of the value stocks that have been so unloved but could perhaps reinvent themselves, become more productive as a result of the new technology available?
Yeah, I think value question is super interesting because, I mean, we know that buying low and selling high, that's a mantra for finance. Lots of Nobel Prize winners kind of, when there are lots of academic research. The problem is that for the last 20 years, that has not happened. For the last 20 years, where cheap stocks were getting cheaper and cheaper. And for us, a fundamental reason for that is kind of overall sluggishness of earnings growth outside tech. So that's the problem. And that's like what investors have to do. They either choose faster growing companies at a high price or slow growing companies at low price, and they seem to be choosing faster growing ones. So what needs to happen, the gap between earnings growth, between growth or tech or large caps, however you want to call it, and everything else needs to shrink. And we see two ways of shrinking this gap. One is constructive. We kind of economic growth reaccelerates, and then cheaper value or the cyclical value will do better. So think about your materials, your small caps, your emerging market trade. That's the trade. So if we have reacceleration of economic and earnings growth outside tech, or you can have a more negative way. We go to recession. everything collapses, profits go down everywhere, then we have big rate cuts, and then as we get out of slump, then you buy, you just buy the cheapest stuff, right? So you get the junk rally. So it's either economic reacceleration or recession. I mean, at the moment, I think both of two scenarios are kind of tail risks, and kind of the central case. What we heard from Powell is this kind of soft landing, and we kind of bump along, and gap between profitability gap is still not closing, and we still are forced to buy this kind of large cap growth companies.
Maria, I just finally want to ask you about defence as a sector. We're seeing the likes of Rheinmetall actually up this morning on German fiscal news as one element. But I do wonder whether there's room to run for the defence names, given the prospect of maybe, hopefully, a ceasefire in Ukraine.
Yeah, I mean, that would be a wonderful Christmas present for all of us, ceasefire and kind of end of hostilities. But in terms of kind of investment case for defense stocks, I think it's a little bit more challenging. And the reason I'm saying so is not because, all of a sudden we need to spend less money. We do need to spend more money on defense. But what we saw at the end of last year and Q1 of this year, that both valuation and positions in those sectors have really increased. What we see in our custodial database, the holdings, institutional investor holdings in defense stocks are almost 3 times higher than the previous max we've seen before kind of recent run-up in positioning. So investors kind of positioned for that. So that's kind of your known story, right? In Q1 last year, we saw like big run-ups in prices there in terms of, okay, we will have more fiscal spending. We will have more kind of better earnings there. So that's kind of known story. So what's a new incremental story? And I guess the risk reward is potentially on the downside because we know money are going there. So if there is any disappointment, then you can see position unwind.
Maria, thank you very much. Thanks for joining us. Maria Weitmaner, Head of Equity Research at State Street Global Markets. Let's have a look at the Core 6 this morning. And the picture across European equities then, and some of the ones that are very much in focus, we've just talked about defence names. Expectations have been in the market for some time about what Germany's going to do fiscally, but it does seem to be having a bit of an impact on some of those players this morning. So Rheinmetall up by 1.8%, ASML higher, Schneider Electric a little higher. They're united, of course, by the tech AI theme. Nestle, LVMH, Novo Nordisk looking a little more sluggish this morning. Let's get some details now. Chloe Melly has our movers this morning. Chloe.
Good morning, Anna. Defence is moving higher this morning as Germany is set to approve 50 billion euros worth of military purchases. And so we are seeing that reflected in those shares across the German defence sector this morning, with Rank Group in particular up at 3.5%. This is an interesting reversal from what we saw yesterday when those companies moved lower because of that prospect of a ceasefire in Ukraine. But perhaps that military purchase is kind of reassuring investors that a peace does not necessarily mean that there will be lower military spending in Europe. And so we are seeing some positive movements across the board in defense this morning. Moving on to some companies that were singled out by the U.S. administration as potential targets for retaliation. So the U.S. administration is threatening to retaliate against the EU because of its plans to tax big American tech companies. And some of those names here were the ones that were mentioned. And we are seeing a lot of weakness, in particular for Capgemini this morning, down about 1%. Quite modest moves, though, so maybe the market is still trying to digest what that actually could mean and whether we'll actually get that retaliation. Moving on to oil, which is moving higher this morning as the U.S. is ramping up pressure on Venezuela and ordered the blockade of sanctioned oil tankers. And we are seeing that moving those shares higher, especially for BP, which is up 1.8%. And then the flip side of that is that we are seeing airlines are moving lower this morning. Oil prices are moving higher. It tends to have that impact there. And so we are seeing Ryanair and Lufthansa edging a little bit lower this morning on the back of those oil prices going up.
Okay, Chloe, thank you so much. Chloe Melly there from our equities team. And coming up on the programme, Bloomberg understands that the tank maker, KNDS, is likely to announce it plans to pursue an IPO. So we'll bring you more on the defence story next. This is Bloomberg.
how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday. Only
on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We are nearly 19 minutes into today's session, and as you can see, it's green across the screen for Europe. The Stoxx 600 up 0.3%, but the outperformer this morning is the FTSE 100. We've just had that UK CPI print coming in lower than expected, but also we have gains for the oil majors off the Venezuela news, and we have Brent trading up over 1% at $59 a barrel, so that benefiting the London exchange. But let's turn to defence now, because Bloomberg understands that Amsterdam-based KNDS is likely to announce as soon as this week that it plans to pursue an IPO. The decision by the Franco-German tank maker comes amid surging demand for defence stocks. They're up this morning, the likes of Rheinmetall turning a corner from yesterday, and Bloomberg's Chief Europe correspondent Oliver Crook joins us now for more. So Ollie, just walk us through the plans and what we know of them for KNDS.
Yeah, so this is a pretty big deal that our deals team has been chasing for quite a while now. There's some real question about what would happen for KNDS. Would they be bought or merged with Rheinmetall? Would they go another route? Now we understand that they were going to plan to put an IPO up. That is what the board has decided for KNDS, which is joint owned by the French and a private German family, to try to get to the market and really benefit from the euphoria that we have seen in the defense sector here in Europe, particularly over the last couple of years. We should say that what we understand is they'll have about a 20 billion euro valuation. That'll make it one of the biggest companies on the Stoxx 600 aerospace and defense. We understand that it will be listed both in Frankfurt and Paris. At least that is the preliminary plan right now. And again, we spoke to Armin Papegger, who is the CEO of Rheinmetall, a couple of weeks ago, asking him, you know, are you going to buy this company? Have you made any headway here? And he said, basically, we don't talk about M&A unless we're a week out, because we are not sure what could happen. And evidently what has happened in this case is that the company will plan to go public.
And what kind of, and this is one IPO then, Ollie, and are we going to see more of this? Are there other businesses such as this waiting in the wings, wanting to raise money, eager to expand quickly and looking to public markets to do that?
Yeah, I think what's been very sort of surprising is in all this euphoria and all this buying of these sort of European defense stocks is you actually have not seen that much deal activity, as much deal activity as you might expect for a company, say, like Rheinmetall, which from the first day of the war in Ukraine is up 1,500%, right? So this is the kind of time where Rheinmetall, which has been much more aggressive companies, would be thinking about doing M&A and looking at these kinds of deals. And I think that if you look at the candidates for M&A within Europe and within defense, Rheinmetall is definitely top of the list there, not just because they're the biggest player in Europe, but also because they are really looking very aggressively in terms of their ambitions, in terms of expanding and not just into sort of narrow fields. A lot of these defense companies are very sort of technical and very sort of centralized on one thing. Rank, for example, does tank transmissions and those sorts of things. Rheinmetall really wants to be the one-stop shop. So I think that we have not quite seen yet the beginning, really, or certainly far from the end of all the M&A activity. And I think that Rheinmetall is going to be the prime candidate to try to find some of those businesses and build out their portfolio inorganically.
Okay, Ollie, thanks very much. Bloomberg's Oliver Crook with the latest on the defence sector and with Europe in mind. Thinking about European equity markets and where they head next, it seems that European investors are the most bullish ever, joining the chorus of upbeat sell-side strategists. That's the focus for today's Taking Stock, which delves into the rarely seen levels of optimism. Bloomberg's Michael Masika is with us now. So European investors feeling pretty bullish, not just those trying to sell them stocks, but the ones with the money putting it in, also sounding pretty bullish then, Michael. So talk us through the findings in this report. What's the extent of this bullishness?
So that's the thing. It's like you have the sell side, which is very, very bullish. We explored that last week in our own survey, with like literally no bear left. I think that the most bearish strategists were seeing just like a couple of % downside for the next year. And this is like a buy-side survey from Bank of America, like that's covering a lot of the European fund managers. And here we have like the most bullish survey on record. 92% of the respondents are expecting upside for European stocks next year. A large part of them double-digit upside. This is very extreme. What's also very extreme here is not just the bullishness about the stocks themselves, it's the fact that cash levels for funds, asset under management, are like the lowest in like 12 years, so like 2013. So yeah, you know, it tells you a lot about the sentiment.
I sense the skepticism from you, Michael. How much of the optimism is already in the price then?
So the skepticism is not coming from the fact I'm bearish or I see a lot of risks ahead or whatever. It's just like when everyone is bullish like that, usually that's when you get slapped in the face. So it doesn't mean that the market will be down next year, not at all. The years the cash level were so low, we had like volatile years, so like we did a bit of drawdowns during the year. But generally, you know, if the outlook is good, the market will be up. That's a given. But we might have a bit of volatility.
And what's the role of... So you make the point also that cash levels have dropped to 2.8% of AUM, and you draw a parallel with this year about people being quite invested. What do we need to know about that, Michael, and what that might do to next year's returns?
So there's two things. Unless they start raising a lot of money and they get some decent inflows, that means that the dry powder is low. So that's one thing. The other thing is what we've seen this year is fund managers chasing the rally all year long. Why? Because they were not enough invested. They started the year like pretty bearish, and so all year long they bought stocks and they increased their exposure to different type of trades. Also, the problem that they had is like the concentration of returns was very, very high, both in the US and in Europe. In Europe, it was the banks, the defense, and obviously you couldn't be exposed as much as, you know, the market was basically, and to get those gains. So fund managers have been chasing. What we've seen now is like they stopped chasing. They really invested. There's less FOMO. They get kind of in a wait-and-see mode. They're there.
Yeah.
So we may have not as much as buy-the-dip action that we've seen.
Yes, less FOMO because they're all at the party, so they're not missing out on the party.
I mean, we've got the ECB's decision tomorrow. Just finally, Michael, I mean, what if they actually turn hawkish into 2026? How much would that knock European stocks?
That would be a surprise. The thing is, there's no reason for them to become really hawkish. The inflation is still under control. The economy is just starting to recover. The expectations for next year are just like a low single-digit growth in Europe. So there's no reason for the bank to turn really hawkish. Now, obviously, if it's a big surprise, then that could knock a decent
Tell that to Isabel Schnabel, Michael.
Michael, thank you very much. Bloomberg's Michael Masik with us this morning to talk about the markets. Just watching some lines dropping from Takaichi, the Japanese Prime Minister. I noticed that the yen is down by 0.5%, so we'll keep an eye on those. Coming up on the programme, though, pressure on another asset class. This is commodities on the oil market as President Trump mounts a blockade of Venezuela. That's pushing oil prices higher this morning. The Ukraine potential for news flow was pushing prices lower yesterday. We'll get an update. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
This is the opening trade. 30 minutes into today's session, into Wednesday's session. Let's have a look at where we are then. European equity markets making some modest gains, net across the European equity market space. Maybe better than modest, up by 0.3% on the stock 600. And the German market pretty much on par with that. The Paris market underperforms a little. The London market outperforms by quite a lot. And that has to do with the oil story. It also has to do with the London rate story, the Bank of England rate expectations after we got that inflation print that came in lower than had been anticipated. That seemed to cement market expectations for tomorrow's rate cut and also led to a bit of a rethink about how many cuts we get next year. So we'll keep that in focus and under review. So, Lizzie, the picture for European equity markets, modestly positive.
Well, reflecting that green across the screen, Anna, the balance of members higher and lower tips to higher, 316 in the green this morning. Here's your volume up 12% on the moving average for the last 20 days. But flip the board over, and a lot of those leaders that we are mentioning in London can be found here. So Shell up because of the oil price, of course, off the Venezuela moves, the blockade up 1.5%, and energy as a sector performing well this morning. HSBC also up nearly 3%, and this is after it was upgraded by KBW. But flip over and I can show you the laggards this morning. Harder to find them, I must say, but it's the likes of Roche, Novo and LVMH. LVMH down more than 1% this morning, Anna.
Let's get an update then, Lizzie, on some of the other stories we need to keep in focus this morning. OpenAI is in initial discussions to raise at least $10 billion from Amazon. According to sources, the deal under discussion could value OpenAI north of $500 billion and see it adopt Amazon's Trainium chips. The agreement would be a win for Amazon's efforts to broaden its AI industry presence. UK inflation slipped to its lowest level in 8 months. The bigger than expected drop is expected to clear the path to an interest rate cut at the Bank of England. And of course, that is on the agenda for tomorrow. And US President Donald Trump is ordering a, quote, complete blockade of sanctioned oil tankers moving in and out of Venezuela. The move increases pressure on Caracas amid a US military buildup in the region and the threat of land strikes. Venezuela condemned Trump's latest measure as a, quote, reckless and serious threat. Lizzie.
Well, continuing on that theme, US President Donald Trump is ordering a complete blockade of sanctioned oil tankers moving in and out of Venezuela. The move increases pressure on Caracas, which is facing a US military buildup. And we can speak now to Ule Hansen, Commodity Strategy Head at Saxo Bank, for analysis. Really good to see you, Ule. Thank you so much for making time. I want to start on the geopolitics, because as I say, we have oil up on the Venezuela story, but it had been down past $55 a barrel because of the Ukraine story. If Venezuela weren't a factor right now, what would be the floor for oil?
Well, the floor for oil, Lizzie, is really depending on this build-up in supply that we've seen starting to impact prices recently. We have these geopolitical risks that add a little bit of a premium back into the price, but the drift that we've seen recently is really one that attracts most of the attention. Yes, we are higher today, but the sanctions barrel out of Venezuela is probably only around 100,000 barrels. But what it does mean, obviously, with this military build-up, how many ships actually want to sail through these straits and into Venezuela? So the impact potentially in the short term could be high in terms of how much Venezuela is cutting their production or how much they can export less. But generally, the overhang of supply is still the overriding theme that for now will be the main driver and the main theme into 2026.
And what happens to oil if the unthinkable happens and President Trump says that peace in Ukraine is off the table? He's known for his surprises.
Well, then we will continue to see some sanctions on Russia, but the market's probably already at this point pricing that in. We're seeing a little bit of tightness in some of the product market, but the crude balances seems pretty ample around the world. But I think it's also important to point out that the longer we stay down here in the 50s, that we are basically sowing the seeds for a future recovery, because this is demand destruction or supply destruction territory from some of the high-cost producers. So even though it might be nice in the coming months from a production or from a producer or consumer perspective, these lower prices, we should not kid ourselves. These will lead to higher prices in the future, perhaps not until late 26 into 27.
So where will that pain, if you're talking, good morning to you, Ule, well, if you're talking about supply destruction, where will that supply destruction come from? Will it be OPEC that pulls back? Will it be US producers? Who will be most responsive to this price signal?
High-cost producers, first of all, and with that in mind, we focus on the U.S. once again. We have already seen some of the numbers for next year that we basically see. EIA is predicting a flat line in terms of production growth next year compared to this, and that could actually start to reverse to become a negative next year. So that will have an impact on prices. And then we clearly also need to keep an eye on OPEC, whether they respond to these lower levels. They haven't shown any signs of that yet. But for now, it's the high-cost producers that will start to suffer first, and the longer we drag out and stay down here, the bigger the impact.
Okay, so these, what you call then lower prices, could have an impact on the level of supply from the US in particular. Let's get another perspective on these oil markets, Ule. The Total Energy CEO, Patrick Pouyanné, says rising oil demand should underpin prices. He spoke to Bloomberg on the sidelines of the Conference of Paris yesterday about the role of oil producers. Let's have a quick listen.
I trust also OPEC countries to manage the situation. You know, you've seen them beginning to slow down. They relinquish oil in the market. If the price is too low, you have a sort of natural counterbalance in the US shale oil, because then the US shale oil producer begin to slow down themselves. So at the end of the day, what I'm sure in economy, demand equals supply.
So, Ule, one voice there from the oil sector suggesting then that the OPEC response here will be not to create supply destruction, he doesn't seem too worried about the impact that this is going to have, this weaker oil price.
I think there is a risk that we could see this supply destruction, but again, depending on how long we stay down here. But and I think it's absolutely paramount important to keep focus on demand, because as long as that continues to show strength in the coming years, which I think most of the major forecasts now forecast, then combined with the depletion rates where you have to find 6 to 8 million barrels just to maintain status quo, that over time does not ring with these current prices in the 50s. So something has to give, and at one point, I believe it will be the price, because demand remains robust around the world.
Well, Ule, when does OPEC Plus pivot from holding to cutting then?
We probably need to see a further drop, but I think also we still haven't seen the full impact of the increases they have announced this year. And I think that Saudi Arabia probably just holding out and see how many can actually deliver those increases, and that will lead to some revisions in targets at some point at a later stage. But for now, we haven't really seen all the increases come into the market. Perhaps also one of the reasons, combined with the continued strength in demand from China, some of that to reserves, that we're not seeing a forward curve indicating any kind of oversupply in the market. We're not nowhere near levels where the so-called carry trade can return, where you have excess crude put on a tank and you make money from storage for a while before you sell it in the forward market. We're nowhere near that. So right now we have a market where the talk of the oversupply doesn't really rhyme with what the futures curve is actually telling us. So something's going to give at some point. But for now, the narrative is that the oversupply will continue to add downward pressure. But I'm a little bit hesitant reluctant to jump into that, simply because the curve is not telling me anything about this so-called oversupply.
Okay, that's interesting. The curve doesn't show you the glut story, and there do seem to be different views out there, Ule, on the extent of it. I mean, Trafigura Group, you point out, talking about a super glut, but OPEC and the IEA, they have different analysis of next year and how much that oversupply is going to be. Why do you think we're in a situation where we have such range of expectations?
That's a good question. Something we struggle a little bit with sometimes too. But obviously, these organizations they have different owners and different backers. So there is perhaps a little bit of politics involved as well. But even if you take the median, we're still looking at a market where there will potentially be a small surplus. But again, as I said, the 4 million barrels that IEA is talking about, I would imagine that the professionals out there, the guys in the physical market, they would price that in, and so far they're not seeing that. We're not seeing that at all. So at this point in time, I'm probably staying on the side of OPEC in terms of their forecast.
On the flip side of all of this, Ule, of course, we have surging metals. Do you expect that divergence between metals and energy to continue into 2026?
In the early passes to 26, yes, this is similar, because the momentum we've seen in the metal market and this demand for tangible assets with tight supply is one that is really difficult to stand in front of, trying to go against. We just saw that again overnight. Platinum and silver, they're both rallying more than 4%. These are two of the metals that are really in focus now in terms of supply tightness and continued demand from industrial users. And as long as we see that, as long as we get that supported by gold strength as well, which is another story, which is all about the uncertainty we have in the world with fiscal debt and uncertainty about the Fed direction and so on. then we'll continue to see this upward move in metals. Energy will struggle in the beginning, but we're already now starting to see that there are the money coming back into the energy sector, because some of these oil majors are trading relatively cheap, and potentially that could be the surprise trade as we move into the second half of next year. So it's definitely on the radar, and that's also why the energy companies have not seen this slump relative to what we've seen in the oil price.
Ule, thank you very much. Thanks for joining us, Ule Hansen, Commodity Strategy Head at Saxo Bank. Coming up on the programme, 8:41 here in London, 9:41 over in Germany, where we are set to get a better sense of business confidence. We are gearing up for the release of the IFO Business Confidence Index, of course. Look at what to expect. That's next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We're 44 minutes into today's session. It's green across the screen, and as you can see, it's outperformance for the London index. The FTSE up 1.25%. The explanation comes partly from the sectoral breakdown. You have energy and basic resources, the best performers, as we were just discussing with Ule Hansen. The Venezuela tanker blockade boosting the oil price, but also factor in that UK CPI print coming in lower than expected. All economists surveyed got it wrong, and that boosting the London stocks as well. London. Anna.
So we're having a look there at the European equity market picture, thinking about the broader European economic context. Let's get to some interesting contributions on that subject from the Citadel founder, Ken Griffin, who says that Europe needs to address its, quote, long-standing issues, adding to a chorus of finance executives urging Europe to act as it considers how to respond to a global rollback of regulations imposed after the financial crisis. He shared his view with Bloomberg's Danny Berger at the Conference of Paris yesterday.
There's no doubt that the Western world needs Europe to be more successful. We need to see higher economic growth in Europe. We need to see more innovation. We need to see more consumer demand for goods and services, because the Western world will only be strong and prosperous if we have a strong and prosperous Europe.
What does the road ahead to get that strong and prosperous Europe look like? How do we get there?
Look, I think Mario Draghi did a fantastic job putting forth a playbook for how to revitalize Europe. And I would say that, I'll agree with 80 or 90% of what he wrote, but rather than regurgitate what he wrote, and he wrote really thoughtfully, I think the salient points are Europe needs to create a culture of entrepreneurism. Far too much of the world's innovation takes place in the United States and in China. And Europe, having such an incredibly well-educated population, should have far more entrepreneurial success stories than it does. So that's a really big issue that Europe needs to address. It's a cultural issue. And the second is that Europe's capital markets simply aren't deep and robust enough. The venture capital community in the United States, the depth of the private equity markets, the depth of the growth equity markets, the depth of the public markets makes it much easier to organize, to secure capital, and to grow a business than it is here in Europe.
Ken Griffin, the founder and CEO of Citadel. Really interesting there, Lizzie, ending those comments, talking about capital markets not being deep enough. Well, what is the antidote to that? Europe talks often about capital markets union, saving investment union, and that's more Europe. And that seems to be the answer coming from Jamie Dimon as well, a stronger Europe, more Europe by some measure. But it's not always clear that the White House has the same assessment, is it? I mean, the national security strategy that we saw from President Trump and his team doesn't put the emphasis on a stronger Europe. It puts the emphasis on what they see as Europe as a threat to the United States.
But I do wonder how much that document was aimed at a domestic audience and how literally we need to take the White House view of Europe at the moment, whether it's really just setting up perhaps J.D. Vance for the future. I wonder about the European response to what you're talking about, this White House impression of Europe. And I think particularly about Keir Starmer, of course, the UK Prime Minister. I think about the BBC News this week and when Starmer is going to stand up for the UK, he's taken such a softly approach to the White House. Is it paying off? And when I think about the trade situation as well, earlier in the programme we were discussing the USTR taking aim at some of the European tech firms and other sectors as well.
Yeah.
That tension could remain a theme in 2026.
Yes, some have praised Starmer for that stance, saying it has delivered for the UK, but we'll see whether we see any pivot in it. The BBC context, important, of course. Let's pivot back to the economic conversation out of Germany then, because we are going to get some data shortly. Closely watched IFO business confidence data. That's coming up in the next 10 minutes or so. Joining us now is Zoe Schneeweiss, Bloomberg's economics editor. Zoe, help us get ready for this data then. What are we waiting for?
So overall, the IFO is the preeminent indicator for the German economy. It's just better than any of the others. The numbers are coming out at just top of the hour are likely to be a bit inconclusive. With all the predictions say that they'll hold steady, expectations will hold steady, current situation, and the overall number also should hold steady. Generally, holding steady is really not good enough for Germany. German economy, as we know, flatlined in the third quarter. This quarter, it might have ticked up ever so slightly, but growth of 0.1%, 0.2% really isn't enough to get that revitalization of the economy that you just were talking about.
So, Zoe, of course, this is going to be a factor into the ECB decision tomorrow. Just set us up for that, what we really should be watching out for. Everyone's telling us it'll be boring, but I feel like the forecast might be the exciting part.
Exactly. You just mentioned we get the new economic forecasts, and those for the first time include numbers for 2028. Now, 2028 obviously is quite far out, and we all know how reliable forecasts have been in recent years. Still, the 2028 number is the one we'll be looking for. Here, we'll be probably less focused on the economy, although Lagarde last week already said that she's expecting economic forecasts to be slightly raised this week. What we will be focused on is the inflation reading. We already know that they all will have to revise down their number for 2027. That's because of this emissions trading scheme, ETS2, that has been delayed. The vital number here will be the number for 2028, and there, if we see anything close to 2, those people on the governing council, and that does seem to be the majority who says rate cuts are done, those will get an extra boost.
Okay, Zoe, and how is, some days later, a week later perhaps, how is what's the fallout in Frankfurt from the comments that we heard from Isabel Schnabel at the ECB, the comments about the next move from the ECB being a hike and a little bit of, caution that it's not coming next week or anything. This is a long distance perspective, but how is that now being perceived where you are?
Her comments have obviously reframed the whole conversation. So it's not just at the ECB. We know that globally, the advanced economies, the idea that rate hikes are on the horizon is one of those things. Here at the ECB, we have heard from some of the policymakers trying to push back. Obviously right now, since last Thursday, they've been in quiet period. But before that, we did hear one of the, shall we say, at the moment, the Uber dove, François Villeroy de Gallo, so the French central bank governor, saying, oh, that's nowhere near there. He's the one who maybe is still holding out for a cut, although he has moved away a bit from that. At the same time, we had the Lithuanian central banker who had kind of moved to the dovish camp and had said, hike or cut, he can't say what the next move will be, now saying he doesn't see any more cuts are coming. So generally, Schnabel, while we know she is definitely the strongest hawk at the moment, her just making those comments has allowed everyone to admit, yes, cuts are over, and hikes, be it far away, is probably the next move.
Let's see how hawkish President Lagarde is tomorrow. Bloomberg's Zoe Schnee-Weiss, we thank you so much for setting us up from Frankfurt. And as we say, on the daybook today at 9 a.m. London time, we'll get those German EFO numbers. Then at 10 a.m. we'll get the Euro area CPI print. And then later on, we've got a after Fed speak. We'll hear from Waller, Bostic and Williams. And indeed, Waller looking a little more interesting now that he's got his interview to be the next Fed chair. But we've got traders sticking to two bets for 2 Fed rate cuts next year after this delayed US jobs report pointed to a continued cooling in the labour market. Attention now turns to inflation data tomorrow, and we can get a preview with Bloomberg's Valerie Teitel. Val, just first of all on the jobs report, a lot of noise, a lot of signals for both the hawks and the doves. In the end, what has the market latched onto?
Well, look, I'm afraid that the noise is really the key theme of yesterday's print, and it might be the key theme of tomorrow's CPI print as well. We even had Powell downplaying the data this week at the press conference last week, saying that there's a lot of distortions in this data because of the hiccups around collecting this data around the government shutdown. But what really was interesting yesterday is the market essentially shrugging off all of the bad news that was in the print. We had that October payroll number coming in at negative 105K. Yes, it was due to a lot of that government disruption, but that is the worst payroll number we've seen since the pandemic. The market also shrugged off a quite decent rise in the unemployment rate, 0.2% tick up to 4.6%. Shrugging it off because a lot of this perhaps had to do with the fact that the BLS collected this data a bit closer to the Thanksgiving holiday and captured maybe some of those teenagers looking for part-time work ahead of the holiday season.
Okay, so there's a bit of a lack of comparability then with the usual data set there, which is an interesting detail, Valerie. Then we move on to another data set in the United States tomorrow, CPI. What's the expectation?
Look, it'll be interesting, especially to see if there's any tariff pass-through that we can parse through in this. I think economists in the market is kind of on tetherhooks waiting to see whether tariff pass-through has already hit us or whether it's still ahead of us in 2026. We might get some hints of that in the report tomorrow. Note that Chair Jerome Powell said in the press conference last week, he said that he does expect goods inflation to peak in the first quarter of next year. So keep an eye on goods inflation. inflation. If we get perhaps a downside surprise in that, it might in some way change the Fed's mind on how they're viewing a tariff-induced inflation at the beginning of next year.
Okay, Valerie, thank you very much. Bloomberg's Valerie Teitel with the a setup for the data that we get tomorrow and a bit of a look back at all of the noise created by yesterday's data set. Let's get talking of noise. There's a lot of noise in the trade conversation right now. We were covering at the top of the program, Lizzie, this story about the US trade representative threatening action against European companies for what the US sees as unfair treatment of US tech. Of course, Europe pushes back against that, and we have a comment from an EU Commission spokesman this morning pushing back against the US trade representative, saying that the EU continues enforcing rules fairly and without discrimination.
It's like
I
they
guess
heard
you might
us.
expect.
I know. I said they needed to push back, and we've had Ursula von der Leyen, of course, the European Commission president, saying we cannot afford to let the worldviews of others define us. None of us should be shocked by what others say about Europe. So that's some strong words from Ursula von der Leyen. I just want to check before we go on UK assets, because of course we started the programme with that UK CPI print coming in weaker than all economists had expected. And the FTSE 100, of course, has been the outperformer on the index front. The pound is still at 133 at the moment, and we've seen the moves on gilt yields lower across the curve, and that actually pairing a little bit, but still down across the curve when it comes to gilts.
Absolutely, and if you look at some of the movement on that FTSE 100, it is those companies that would benefit from a lower interest rate environment. So some of the house builders, for example, that are making their presence felt to the upside, along with some financials as well. Coming up later on in programming, the president of Kosovo is on the pulse. That's at 9:15 London time, so in around 20 minutes, in fact. That is it for the opening trade. The pulse is up next. They'll continue to take you through this market story. US futures flat to positive this morning. That's it from this program. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything. Bringing you up to the minute news whenever and wherever it happens. I'm Sherrian in Seoul, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
President Trump orders a naval blockade of sanctioned oil tankers entering and leaving Venezuela, increasing pressure on Caracas as the U.S. expands its military presence in the region. UK inflation drops to its lowest level in 8 months, all but sealing a rate cut from the Bank of England tomorrow. Plus, OpenAI is in talks to raise at least $10 billion from Amazon and use its chips in a deal that would value the AI startup north of $500 billion. I don't know if we can still call it a startup, but this is the picture for cross assets. A lot of the focus is, of course, on what we're seeing with dollar, gold, and oil. Now, treasuries and U.S. stocks overall, U.S. futures actually posting small moves. The dollar climbing, jobs data did little to strengthen the case for further Federal Reserve interest rate cuts. If you look at a couple of other things, we're watching oil very closely. We have Brent, the London-based oil, or the London-traded oil, at 60.27, oil advancing after Donald Trump ramped up his pressure on Venezuela. And again, gold also rising, pushing it close to the record set in October. A couple of data points we're also watching out for: Germany, December IFO business confidence, that index coming in at 87.6, a touch below estimates, but really it doesn't seem like a huge discrepancy. This is the picture for the European markets. A lot of the focus will be not only on the UK with the slowest print in 8 months, which has an impact on pound, but what this means for some of the earnings based, of course, in the UK. And if you look at the labour market in the UK, I'm looking forward to the Bank of England tomorrow to see exactly how they see it going forward. You can see there's little gains across the board, but still we're seeing green with the CAC 40 gaining, as well as the DAX and the FTSE. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a cooling U.S. labour market and UK inflation dropping more than expected. In just a moment, we'll discuss all of the data headlines with Josie Anderson, European economist at Nomura. But first, a grave violation of international law is how Caracas is describing the U.S. move to blockade sanctioned oil tankers moving in and out of Venezuela. Now, it follows a U.S. military buildup in the region, with the White House accusing Venezuelan President Nicolas Maduro of presiding over narco-trafficking operations. So let's bring in Will Kennedy for Europe, Middle East, and Africa. Will, thank you so much for joining us. I mean, this is really an escalation, a significant escalation. What could happen next?
It is a significant escalation, and it's clear that the Trump wants to put a lot of pressure on Maduro with an aim to frankly speaking, get him out of office. And this is a part of that process. We've seen pressure put on in other ways, the military build-up in the region, the strikes on boats, which the Trump regime accuses of drug trafficking. But this will really put a lot of pressure on the Maduro regime. It's very dependent on the revenue it gets from oil imports for its hard currency earnings to support the regime. And if this really stops those tankers, that oil flowing, it will make life very difficult for the Venezuelan government.
What does Trump want there?
Trump wants, I think,
oil.
Well, yes, he does, and I think he wants a new regime in Venezuela. The thing about the Venezuelan oil industry, was hugely important. The reserves are among the biggest in the world, but over the 25 years so that we've had this socialist regime in Venezuela, we've seen oil production, oil exports progressively decline. At the moment, they're only exporting a little over 500,000 barrels a day, and that's against the context of global demand of more than 100 million barrels a day. So they're not that vital to the oil market today, but there are huge opportunities there if there was a change in regime, and I think Trump sees the opportunity for the U.S. oil industry.
Well, oil is about at $60 a barrel. There are a lot of fears about a glut. There's a lot of hope about some kind of ceasefire in Ukraine. How much uncertainty is Venezuela and in general U.S. foreign policy adding to the price of oil?
Yep, I mean, Trump has shown himself to use sanctions, oil sanctions, as a way of achieving political ends. So you've got these sanctions and this action on Venezuela. You've got sanctions on the Russian oil industry, and that has added some upward pressure, but it's against the background of a much more bearish picture in general the market appears very oversupplied. There's a huge amount of oil in tankers on the water. We saw Brent trade below 60 yesterday for the first time since May. And there's a bit of a reaction today, but I don't think it changes the broader market narrative, which is pretty bearish right now.
So is there going to be, is there a glut in 2026? We spoke to the TotalEnergies chief executive yesterday, and he really pushed back against that.
He did, and I think his argument would be that demand continues to be strong, demand continues to push to the upside. I mean, he does have quite a lot of oil to sell, but and so there is that countervailing force in that, if the global economy stays relatively robust, demand will rise. We've seen less emphasis on the energy transition. You saw the news about EVs in Europe, which sort of sets the mood. So there is that countervailing trend, but right now there is an oversupply in the market, and people do in the early part of next year. Most people expect prices to trend a little bit lower.
Well, thanks so much, as ever, Will Kennedy, Bloomberg's news director for Europe, Middle East, and Africa. One of the busiest people at Bloomberg, I would say. Now, another important headline crossing the Bloomberg terminal on geopolitics. The U.S. is preparing a fresh round of sanctions on Russia's energy sector to increase the pressure on Moscow should President Vladimir Putin reject a peace agreement with Ukraine. That's according to people familiar with the matter. Now, Bloomberg understands that the U.S. is considering options such as targeting vessels in Russia's so-called shadow fleet of tankers used to transport Moscow's oil, as well as traders who facilitate the transactions. Now let's dive a little deeper into the markets. After the cooling in the U.S. labor market and UK inflation actually falling to its lowest level in 8 months, we also need to look ahead to decisions from the Bank of England and the ECB, with the Bank of Japan due on Friday. Well, we're joined by Josie Anderson, European economist at Nomura. Josie, thank you for joining us. When you look, first of all, at UK inflation here in the UK, what does that mean for the BOE decision? It seems to be making their life a little bit easier.
Yeah, I think it does. And the surprise slowing of UK inflation this morning, which was fairly broad-based, we think doesn't just add to the chances of a rate cut tomorrow. We actually think tomorrow we could see more people than we previously thought voting for a cut, perhaps even an 8-1 split, or Taylor voting for a 50-bip cut as well. But looking ahead, we could even see, we've seen more aggressive pricing for cuts next year. It could raise the probability of more cuts than we currently think happening next year.
So when you look into next year, are we going to see a bit more stickier inflation? Again, the UK is a little bit more complex because of domestic issues, some of the labour policies put in place, and again, it's a small open economy.
Yeah, exactly. So global factors play such a key role in UK inflation. But aside from any surprises, we do see it slowing back towards target next year. And of course, that's what we think will allow the Bank of England to cut the policy rate into what it sees as broadly neutral territory, which is quite a wide range, admittedly, of 2 to 4%.
What does it mean in terms of, if you look at the differential between the US and the UK, but also the Bank of Japan, is there a danger that, the Bank of England governor needs to look at this? And actually, he has been the deciding vote. How much does he think about external factors?
Yeah, of course. And, the US cutting rates more next year. We see 2 more rate cuts next year. Of course, policy rate differentials can play key roles in FX moves and therefore inflation, in particular through import prices. We currently don't see those 2 cuts we expect in the US adding to our expectations of rate cuts next year. We see 1 more rate cut after tomorrow happening in April. But of course, if the US economy surprises us to the downside next year, if GDP growth is slower and there are more rate cuts in the US, then we might be looking at how that will impact the UK.
And Josie, is this regardless of who's the next Fed chair?
Well, we do see the possibility that the next Fed chair will be more dovish, will play into the probability of rate cuts next year. We don't expect any more rate cuts under Powell being chair. And we also do actually expect factors like AI to raise GDP growth in the US next year. And we still expect cuts despite that, because we do expect the next Fed chair to play a role in adding to reasoning for them.
Josie, what's your take on ECB? So we had this fantastic interview with Isabel Schnabel that's kind of changed the way that the market perceives the ECB interest rate dynamic. Do you think the next move is a hike, and how soon could we get it?
In terms of the next move, we think that will be driven by a shock, not fundamentals, because at 2%, the policy rate in the euro area is neutral, and the ECB has been clear that it is in a good place. And so, we think there are actually many downside risks to inflation next year. We don't expect a cut. We expect it to remain at 2%. But things like slowing wage growth, the recent appreciation of the euro, are factors that could add to slowing inflation, and indeed base effects from energy will, we think, contribute to slower inflation, particularly at the start of next year. We think they'll look through that, but it will still play a role in slowing inflation.
What's the biggest problem Europe is facing right now? I know it's, competitiveness is not where it should be, productivity. There's a lot of concern about, for example, politics in Germany and France, even with the lack of a budget. Will that overshadow some of the economic prowess of the region next year?
Yeah, we're really excited by German fiscal spending. We think this is a key theme looking into next year, and this will boost GDP growth. But obviously, we've got to balance that with fiscal tightening in places like France and Spain. We think, it will contribute to growth. We see growth picking up to 0.4% quarter on quarter by the end of next year. And we do think also, increased defense spending will feed into that, as well as the gradual increase in growth of consumer spending, particularly perhaps as savings rates ease, because that's a key question about in the UK as well, whether they will ease. And so we are quite positive on growth, but there are these risk factors, including perhaps slower spending from the government, the German government. If that, comes in surprisingly slowly, then that could push growth further into the future.
And Josie, when it comes to the Bank of Japan, they're just going the other way. How difficult is it to go against the grain?
Yeah, well, Japan, it beats to its own drum. We do think that this week they will definitely hike. But then actually we see a pause for all of next year and then 2 more hikes in 2027. And so we do actually see inflation slowing next year, and that's why we don't think that there'll be those hikes for a year. They'll take a pause. But this week they'll hike.
Thank you so much for joining us. Josie Anderson, their European economist at Nomura. Now, Ken Griffin, the Citadel founder and chief executive, says Republican policies on tariffs and immigration are driving inflation. In a conversation with Bloomberg in Paris, he said the push for deregulation will ultimately stem those pressures in the long run.
The big picture is the American consumer is tired of the persistent and sticky inflation. They feel like they can't get ahead in a world where their savings and their wages are constantly deprecated by the impact of inflation.
Why aren't Republicans speaking to that? Is it an issue of not having the policies, of not communicating the policies correctly?
So I think it's actually fairly complicated. I think that the Republicans struggle with the reality that many of their policies, which they ran on, for example, ending illegal immigration into the United States, are actually pro-inflationary, right? When you end illegal immigration, you reduce the size of the available workforce, that's pro-inflation. And so the Republicans are grappling with tariffs, another case study. When you impose a tariff, it's a regressive tax on consumers. It's pro-inflation. So some of the very policies that the Republicans have put forth and have been successful in implementing are actually the very policies that tend to be pro-inflation. Some of the other policies, for example, deregulation, are just going to take longer to play out. And ultimately, deregulation, which should unleash productivity gains, will create a reduction in inflation, a very healthy reduction. But we need to get to that point in time.
Ken Griffin there, the Citadel founder and chief executive, speaking to our Danny Berger. Now, coming up, as EU and West Balkan leaders meet in Brussels today, we'll be speaking with the president of the Republic of Kosovo. That's next, with the country in political deadlock. This is Bloomberg.
I'm Haslinda Amin in Bangkok. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Kosovo will return to the polls for a second snap vote this year, as months of political deadlock stall Kosovo's ambitions to join the EU and tensions with Serbia continue to simmer. EU and West Balkan leaders meet in Brussels today. Let's go to Bloomberg's Chief Europe correspondent, Oliver Crook, who's with the country's president.
That's right, Francine. Thank you so much. We're very pleased to be joined in the studio by the president of Kosovo, President Osmani. Thank you so much for taking the time and speaking to us on the sidelines of the EU Western Balkan Summit. I'd like to start, if we might, on the situation in Ukraine. The Trump administration, if it is to be believed, we could be at the beginning of an endgame of that war. One of the contributions that's been floated from the EU side is potentially fast-tracking Ukraine to EU membership, they say as early as 2027. As a country, like so many of the other Western Balkans, who have been waiting to get into the EU for a very long time, how do you view that?
We fully support Ukraine's membership in the European Union. Obviously, we wish this to be a merit-based process for everyone, not just for Ukraine and for ourselves, but everyone, every aspiring member. So we do hope that, of course, criteria will be fulfilled, while at the same time we need to look at this from a strategic and security imperative as well. I think a Ukraine in the European Union will make the entire continent safer, the same way a Kosovo and a Western Balkans, based on merit within the European Union, will contribute to this dream that starts with the founders and continues to date. That a Europe whole, free, and at peace is something that we all strive for. So I do hope that, of course, Ukraine moves forward, but at the same time that the European Union member states will not forget about the rest of us that have been striving, have been working, have been 100% aligning with the European Union on common foreign and security policy, as well as really standing with the values of the European Union and what the Union stands for, even when it's hard, even when it has a high political cost, and even if that means also creating other adversaries, having Russia, China, and countries like Iran with crazy ideologies trying to push forward their influence, and us really rejecting it because we believe in the European Union, and also reforming internally should be something that is not taken for granted, but actually used to move us forward much faster.
And I'd like to get your perspective as we enter now almost 4 years of war in Ukraine, and how that has shifted kind of the politics of the Balkans, how it's shifted the power dynamic within the Balkans, and what the assessment has been for sort of domestically for Kosovo, but more broadly for the region.
Well, initially after the Russian invasion of Ukraine, what we had hoped was that many would have learned the lesson that appeasing dictators, appeasing crazy hegemonic leaders like Putin is never the answer. Quite the opposite. The more people like him are appeased, the less there is a chance for peace, and the more they would be kind of incited to use violence. At the beginning, that was the feeling, but then what we see is that in our region, the European Union and many countries within the EU, not all, of course, continue to appease Vučić, who is a mini Putin in our region. And this appeasement has led him to use more violence against neighbors, looking at neighbors as temporary states, becoming more and more aggressive, while at the same time he gets the EU money and does not align with the European Union, whether on sanctions against Russia or sanctions against Iran or other fundamental values and decisions of the European Union. This has made the region, I would say, less safe, less stable, and less peaceful. So we do hope that right now, while of course we see that the support for Ukraine is continuing by most European Union member states, that at the same time the Western Balkans will not be forgotten, that those countries that are fully aligned can move ahead. But at the same time, if there is one country, in this case particularly Serbia, that is a continuous source of instability, that the EU will be more firm and more decisive in dealing with that.
And I'd like to get your perspective as well on Donald Trump, the other sort of large geopolitical event of the moment, and its influence on the Balkans and potentially on relations with Serbia. Do you think that Donald Trump, will he be sort of, do you welcome his attention on the sort of tensions that exist between Kosovo and Serbia? Do you think that he could be a helpful factor there in rushing them down and getting to a breakthrough in normalization?
President Trump has already been a helpful factor. Since the beginning of the mandate, his administration has shown a lot of attention to the Western Balkans, and he has personally been involved, as he stated multiple times publicly, in supporting peace, not just between Kosovo and Serbia, but supporting peace in the wider region. He personally got involved, including members of his administration, in stopping an escalation that happened recently, and we have the attention of his entire administration to make sure that we sustain peace. And of course, through the support of the United States, we have U.S. forces in our region, more particularly in Kosovo. And that is the biggest deterrent, I would say, and the biggest prevention to an escalation in the region. Kosovo has been a full contributor to peace and stability in the region, but obviously we have a crazy neighbor that needs to be stopped now and then. And the role of President Trump, the peace through strength formula, it's exactly what works in the Western Balkans.
And how concerned are you about the change potentially in the U.S. troop posture? You say that it's one of the really sort of critical things. We saw the national security strategy that came out a couple of weeks ago, where very emphatically the United States wants to take its attention and critically its troops away from Europe. How concerning is that to you?
Look, Kosovo is an American success story. It's a flawless American foreign policy success story. Of course, we've been blessed to have a bipartisan support. It was during a Republican government that we declared independence. It was during Trump 1 that we've achieved a lot of successes, and now we truly believe that during Trump 2, there can be a breakthrough on many of the issues that were left aside when it comes to the Western Balkans. The American posture in this region, while it's a small one, it's about 500, 600 troops, the impact is enormous. Just imagine, in a region that peace never existed for centuries, actually for millennia, it is the very first time in the history of the existence of that region that there is peace, that children can go to bed without the sounds of firearms and bombs and grenades. And that is an amazing contribution of the United States of America. So I strongly believe that there would be no change to that, because the Western Balkans as a region of Europe has always been very important to President Trump and will contribute to this peace continuing and stability growing.
And on that constructive note, what to you are the next steps for normalization with Serbia? We see tensions are sort of escalating. What for you is the main impediment right now?
The main impediment is the leader of Serbia, who used to serve as Milosevic's propaganda minister during the wars in former Yugoslavia. His mindset is one that wants to take us back. The rest of us in the Western Balkans, we want to move ahead. We want to move ahead with Euro-Atlantic integration. We want economic development. We want cooperation with one another. We want to make sure that our past does not become our children's future. We want them to live in peace. We want them to never know war, and we want to become successful members of the European Union and NATO and work closely with the United States of America in projects that will make both of our nations more prosperous. So that is the impediment, obviously, with the leadership of Serbia, but we truly hope that they will get there too, and the sooner, obviously, better for the people of Serbia too, so that the entire region can move ahead with integration.
And I'd like to talk about some of the domestic politics within Kosovo. At the moment, we have a great political fragmentation within within Kosovo, inability to form a government. You have an election just a few days away, just under 2 weeks away. Do you expect that that election will bring something definitive, that it will break through the deadlock? And if not, do you expect another election next year?
Well, what happened in the past couple of months was actually democracy playing its work and its role. Obviously, in our constitution, if no coalition is formed, we have to go to elections again, and that's exactly what's happening right now. But from the language that is used by the leaders of the political party, I already see a more constructive role from each and every one of them, no red lines to work with one another. So I do hope that we will have a government very, very soon. Once elections are formed, we expect a speedy process of confirming the results of the elections, the formation of the parliament now with some of the procedures already in place and clarified by the Constitutional Court. I'm very, very hopeful. Obviously, that is going to be in the hands of the political parties, but we do need institutions so that we can also move ahead with huge projects with the European Union and the United States of America.
And just in the last 45 seconds that we have here, your mandate ends in April. Would you put yourself forward to be president once again?
I will have a much clearer answer to that once we have a parliament, because of course it will depend clearly on the composition of the parliament. But I do hope that Kosovo, and I do hope that the political parties will agree that Kosovo needs continuity, especially in foreign policy, which is an extremely important part of moving Kosovo forward.
Would you like to be president again, independent of the parliament?
I'll decide what the people of Kosovo want to, and I will move ahead with based on their will, as it always has been.
Well, Vjosa Osmani, thank you so much for your time there. That the president of Kosovo here
thank you very
speaking
much.
on the sidelines of the Western Balkan Summit in the EU.
Ollie, thank you. Our Chief Europe correspondent, Oliver Crook, with the president. Coming up, more of our exclusive interview with Patrick Pouyanné, the Total Energy chief executive, who says rising demand for oil will underpin prices. That's next, and this is Bloomberg.
I just wondered if any of you had a perspective of the reason to, put some of that capital into women's sports.
It's going to create you the fastest return. You will have so much success. If you look at the growth metrics of women's football, selfishly, in this country at the moment, it's phenomenal. We are the fastest growing sport on the planet. Our participation is up in this country. The interest that is around women's football is at a real, to your point, we're at a real moment in time to be able to capitalise on it. And if I was an investor looking to come into football in this country at the moment, I'd certainly be considering women's, because I don't have to invest an astronomical amount to become the best in the world, to really be put on the global stage, to be winning Champions League. Whereas if I wanted to do that in men's football in Europe, that's going to cost me a lot of money.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump orders a naval blockade of sanctioned oil tankers entering and leaving Venezuela. That increases pressure on Caracas as the U.S. expands its military presence in the region. Bloomberg understands that the U.S. is preparing a fresh round of sanctions on the Russian energy sector should President Putin reject a peace agreement with Ukraine. Plus, OpenAI is in talks to raise at least $10 billion from Amazon and use its chips in a deal that could value the company north of $500 billion. Now, private sector activity in the euro area grew less than anticipated in December as Germany's industrial sector unexpectedly deteriorated. Data from IFO this hour also showing that business confidence is dipping in the region's largest economy. Well, joining us now is Konstantin Veit, a European rates portfolio manager at PIMCO. Konstantin, thank you so much for joining us. Look, the dynamics in the European Union have always been complicated, but do you see a 2, 3, or 4-speed Europe at the moment?
The institutional configuration is obviously peculiar in Europe, and it's difficult to come to a consensus in general. And typically, it takes a crisis to make big progress when it comes to the setup. So it's always difficult to agree amongst a large number of countries. And some jurisdictions are certainly more willing to move forward than others. So typically it's a bit slow, but I think it's not different today than at any time it has been over the last 10 or 20 years.
Do you think the ECB is done? Is the next move likely to be a hike rather than a cut?
I think the ECB is done, but the verdict is out on the direction of travel. So we will be watching. So if you look at inflation, it's broadly a target. Growth is around trend. 2% is probably the midpoint of a neutral range. So there's no reason for the ECB to do anything. And where it goes from here depends on a bunch of things, like, for example, what fiscal is doing, where wages go, where the wages develop in line with the staff projections. We get new projections tomorrow. So that will be interesting to see. But I don't know whether it will be a cut or a hike in terms of next move.
But with Isabel Schnabel actually saying that it is a hike, is it messaging the markets, or is it because, again, is it just because the markets are waiting for something, whereas actually the ECB is in a pretty good place?
Schnabel is obviously very influential, but she's also a well-known hawk, and she's focused more on the medium-term upside risks to inflation, and she is not, overly concerned about small deviations from target over the near term. So the ECB projects an undershoot of inflation next year, and the question is to what extent this would warrant a policy response, and she just thinks that the ECB is in a position to look through. And Philip Lane actually gave a speech on this and said, if it's a supply shock driven by, for example, energy base effects, there's no reason to be overly worried.
Where do you find value in Europe?
I think it's interesting that not too long ago we have talked about Japanification of the euro area, and we have been in negative policy rates, and we thought we would never get out of there. So Europe was not a particularly attractive place to invest in, which is very different now. So Europe is back. Rates are reasonable. And the good news for investors, I think, these days is you don't have to take a lot of risk to earn a decent return on your investment. It was very different 10 years ago, where you had to reach out the interest rate spectrum or the credit spectrum. So you can keep it fairly high quality these days, short in terms of interest rate risks and up in quality in terms of credit risk, for example.
But do you do, is it Italians, or France still doesn't have a real budget? I don't know whether there's an expectation there that something advances pretty quickly. So do you play country against each other?
Yes, there's a lot of relative value you can play. I think it's interesting if you look at France, and, France is not different to other jurisdictions in a sense that you have seen repricing on the back of changes in fundamentals across countries. You have seen it in the US, you have seen it in the UK, in Japan. Germany in March, for example, we had the 10-year in Germany move 50 basis points. on the debt brake developments we've seen back then. And now France has repriced 20 basis points, say, on the back of like worsening fundamentals, which strikes us as reasonable. And, you know, if you look at the budget plans from here, you know, Italy seems to get their act together. France is a bit more questionable. But also Germany, you know, if they don't improve the productive capacity of the economy, you could in 10 years end up with a worse trajectory than Spain, for example, in Germany. So it's quite interesting indeed in terms of relative value across jurisdictions.
But Constance, how do you see Germany right now? Because there is a lot of, because of the defense spending, there's a lot of hope pinned on that, also having a pretty big impact, I think, from 2027 on GDP. But again, politically, the chancellor seems weakened.
Yeah, we do agree with a cyclical boost. So we see stronger growth over the near term, but we do not see the reforms that would make us hopeful in terms of raising growth potential in Germany, which is important for that trajectory over the medium term. So yes, near term, that will be helpful. But over the medium and longer term, we don't think it raises growth potential. And as such, we're not like overly optimistic in terms of fiscal dynamics when it comes to Germany as well.
Constantine, what kind of duration do you like on European bonds?
We like the intermediate part of the curve, so anything between 5 and 10 year is a good place to be, while we are cautious on the longer end. We have been for a long time. And the yield curves have re-steepened quite a bit, so you want to take a little bit less risk there than you have done before. But we have the Dutch pension transition, for example, coming up, which is a big topic in the market. So overall, there might be still some room for yield curves to steepen on the back of this.
I was going to ask you actually about the Dutch pension transition, which seems to be one of the most talked about topics in European rates. So how do you see that impact playing out in the markets?
Yeah, it's interesting. So the first point I would make is curves have adjusted already. So there have been a big re-steepening, big normalizing of yield curves around the globe. If you look at where curves are right now, they are not too far away from pre-pandemic averages. So the bulk of the adjustment should certainly be behind us. The second point is also, that's obviously a topic that has been much talked about and is well flagged. So you would expect a lot of it to be in the price. And also remember when we talked about QE, for example, it was always an announcement effect you had. And then when the first bond has actually been bought, you saw the reverse effects actually kicking in. So it's unknown what the flows will be. A lot of pre-positioning has happened already in the markets. So I think what is clear is that we will see a lot more volatility in the long end next year. And I think it's prudent to have a modest steepener exposure, and then, you know, you can add on volatility on the back of the Dutch developments.
Constantine, so good to speak to you. Thank you so much. On a big week, actually, for everyone, especially if you're in rates, European rates. Constantine Veit, European rates portfolio manager for PIMCO. Now, the chief executive of TotalEnergies says he expects rising demand for oil despite the recent slump in prices. Now, I spoke with Patrick Pouyanné in an exclusive interview in Paris.
I trust also OPEC countries to manage the situation. You know, you've seen them beginning to slow down. They relinquish oil in the market. If the price is too low, you have a sort of natural counterbalance in the U.S. shale oil, because then the U.S. shale oil producer begin to slow down themselves. So at the end of the day, what I'm sure in economy, demand equals supply. So then the rest is going to inventories and the price will adapt. But you know, the world is not linear. You know, since I'm CEO, I've seen it going down from 100 to 17, 27, 80. We have, last 3 years, it was almost at $80, $70. So it was very good, I know, but it will go down and then it will rebound. It will rebound because fundamentally, because of the energy transition, I think we don't invest enough in this oil business. And so if they slow down, then you will see price will go up again.
So you're the biggest exporters, of course, of U.S. LNG to Europe. Do you worry about prices there, that they put extra pressure?
It's very important what you just said.
Yeah.
Because I read recently an editorial in the Wall Street Journal which was accusing us not to be good U.S. citizens. We are, and now we are the #1 exporter of U.S. energy to Europe. We are fully committed to U.S. energy. We are investing $20 billion in new plants in U.S. energy. We have this year sanctioned an additional train in next decade in Rio Grande. We are the largest one, #1.
When sanctions are lifted, if sanctions are lifted, are you ready back to do business, or are there other considerations?
We will obey, for sure, to all the European regulations. So Europe has recently decided that they want to stop imports of LNG from Russia, will stop import of LNG from Russia. There is no doubt. Yeah. Today we have continued, it's well known, we are importing LNG from Yamal because it was part of the security of supply scheme. I said myself to the European leaders, you know, from 27 there will be enough coming from the US. So you can replace the Russian LNG without having an impact on the market. 26 is in between. I don't know. Today we see a little lower, but honestly, $10 is quite a good high price, still a high price. So I would say 26. No, I think the gas price will remain, I would say, comfortable. 27, I think we'll go down.
When sanctions are lifted on Russian gas and oil, what will you do?
We'll see. I'm not sure they will be lifted quickly. We'll see. You know, as this scenario, we'll see what we will do. You know, it depends. For sure, investing a lot in Russia, not, to be clear. We have some lessons, you know. We were quite a big investor in Russia, almost $15 billion of investments. We draw some lessons. We have made a big write-off of our assets there. So, you know, the world is big. So today we have shifted from Russia to the US. This will be maintained. Then we will observe. You know, it will take time because it's a matter of trust. And, you know, in this business, in energy, you invest for 10, 15 years. So building the trust is just fundamental. It's not a matter of geopolitics. It's, for me, the matter will the board of Total Energies trust to put a lot of money in Russia today? It will take time. We'll need to be sure that if there is a peace, this peace is sustainable, which, by the way, I hope as well for the whole continent. So we are, from this perspective, a company like Total Energies is behaving as a society. You know, we have to draw lessons. So we'll see what we will do, but honestly, we'll not rush immediately.
There are a number of Lukoil assets that will be put on the market.
Well, it's not for me. I have enough projects.
There's nothing that you're willing to buy or willing to
No,
look
in fact,
at?
we are partnered with Lukoil in one refinery in the Netherlands. Yeah. So we have found a solution with them.
You can increase that. Are you looking
No, but they prefer to keep their shares. What we have decided is that Total Energies will run the refineries as if it's a 100% assets for Total Energies. We'll take all the cost, all the revenues, so I'm fine. I'm an interim owner, 100% of that refinery, which is quite profitable. And when Lukoil will be out of sanction, they will come back. Okay, they prefer to keep that scheme. We'll see if they sell their whole portfolio. We'll see who will be the buyer. We have a preemption right, so we'll see what we'll decide.
The Total Energy CEO there speaking to me in Paris. Now, coming up, a shake-up in the battle for Warner Brothers after Jared Kushner's Affinity Partners pulls out of Paramount's takeover bid. More on that story next, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity.
only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Warner Brothers is understood to be planning to reject Paramount's hostile takeover bid as a major backer walks away from the deal. Affinity Partners, Jared Kushner's private equity firm, is exiting from the takeover battle. For the latest, let's bring in Manuel Baigorri, our deals reporter. Manuel, why is Kushner's Affinity Partners walking away?
Why is he walking away, right, Francine, from one of the most exciting takeover battles that we are seeing, which is going to transform potentially the entertainment industry in the U.S. and even more so globally, perhaps. I mean, there are reasons. I mean, the deal became very political, highly controversial over the last couple of weeks as you know, the whole situation unfolded, the agreed deal with Netflix, and then how Paramount came with a hostile bid. Obviously, Affinity was one of the backers. Even if the ticket size, we understand it wasn't that big, it was around $200 million, but still very significant given Jared Kushner is behind it, and also it's the deal per se with Paramount is on the verge of collapsing, perhaps, or at least being rejected by Warner Brothers. That's something that we may see as soon as today.
Where does this leave the takeover battle now?
Yeah, the next steps, Francine, remain unseen. I mean, it's most likely we will see Warner Brothers urging the shareholders to reject Paramount's hostile bid. That is the most imminent next step, I would say. But then what's interesting to see will be what Paramount's next moves will be, either walking away, either sweetening the bid, tweaking the financial terms or the financing package, which was, by the way, seen, according to our sources, as one of the main concerns by Warner Brothers board to urge the shareholders to reject the bid by Paramount. So it remains to be seen, but I think we're going to see next steps fairly imminently.
All right, Manuel, thank you. Manuel Baigorri, Bloomberg Deals reporter. Now, the Trump administration is threatening to retaliate against the EU over efforts to tax American tech companies. The Office of the U.S. Trade Representative said in a social media post it would use every tool at its disposal to counter EU measures. The department singled out prominent European companies, including Accenture, Siemens, and Spotify, as possible targets. Well, OpenAI is also in an initial discussion to raise at least $10 billion from Amazon. According to Bloomberg sources, the deal under discussion could value OpenAI north of $500 billion and see it adopt Amazon's Trainium chip. Now, for more, we're joined by Peter Elstrom, our executive editor for global technology. I know you've been busy, Peter. I feel like 2026, you're going to be even more busy given all of the deals that we know about it.
Yeah, there are a lot of deals going on in AI right now, and OpenAI really is at the heart of so many of them. So OpenAI has been, Sam Altman and OpenAI have been diversifying their suppliers in a number of key areas. In the chip space in particular, everybody is pretty dependent on NVIDIA. Of course, NVIDIA now the most valuable company in the world. Partly that's because everybody has to buy their chips to be able to train these AI models and mostly to run them so far. That's given them incredible margins, you know, huge profits and revenue growth. So in this case, we're seeing Altman and OpenAI trying to diversify on the chips front, where they've looked at AMD, one of the competitors to NVIDIA in the past, and now they're talking with Amazon about using Amazon's chips within their operations too. That would probably bring their costs down a fair bit, and it makes it more competitive for NVIDIA to be able to bid and get its chips into the OpenAI data centers.
But so, you know, what does this mean for Amazon's AI chip ambitions? Because this is something that they've also highlighted.
They've been trying to push this very hard. Amazon, of course, is the leader in cloud computing services, the traditional variations that we saw before AI services. Now you're seeing a lot of competition in AI cloud services in particular, and Amazon is a step behind. They're trying to use their chips, the Trainium chips, to be able to catch up a bit. They think that that's a valuable offer for a lot of the AI companies out there, and they think that this would be, you know, a significant step. being able to get OpenAI to be able to buy these chips would be a big step forward for them.
In China, another homegrown chip company having a hugely successful IPO. What do we know about MetaX?
Yeah, not to be confused with Meta, the company in California. This is MetaX. It's a chip company that just went public in China. And you're seeing some incredible stories within the Chinese chip space, speaking of competition in AI chips. So MetaX went public. Its shares went up almost 700%. Its market cap is now $47 billion. It's a big company. It's significant. And most of us have never heard of it before. This comes just shortly after another company, More Threads, went public and also reached a valuation of about that level. So I think it shows the intense retail interest, retail investor interest in these kinds of chip companies within China, because they know that most NVIDIA chips cannot be sold into China at this point. There's a big opportunity for local players to be able to supply the local market and make some big revenue from it. The multiples on these stocks, though, are kind of out of this world, much higher than NVIDIA's.
Peter, I mean, it was almost like a year ago that we heard about DeepSeek, and people in the know really knew about it, but some of the common mortals hadn't really heard about it. What do we know so far about where China is with chips and AI?
Well, they're making progress. They're still very far behind, I'd say, on both of those fronts, particularly on chips. They have a long ways to catch up to NVIDIA. You've seen CEO Jensen Huang make the case that he wants to be able to sell more chips into China. He got the blessing to sell these H200 chips, but there's still a market there, and they're still quite a bit behind. On the AI services front, it's quite a bit different. DeepSeek, Alibaba, the other leaders within the China market are really taking the open source route. They're looking not so much at building these enormous data centers and trying to make a lot of money from those services. They want to do open source. They want to go lower cost route to be able to get AI integrated into business operations much more quickly. That, of course, is with the support and the blessing of the Beijing government.
But Peter, when you look at how they're trying to actually spur domestic demand for chips, I mean, is this going to be the big story for China in 2026, that this will be a success?
They're making progress, and this is a big policy debate in Washington right now, whether the Chinese domestic players, really led by Huawei Technologies, to be clear. Huawei is really the leader. There's a smaller company, Cameracon, that is also competitive within that space, but they're going to be the leading providers. They need to have their chips manufactured by SMIC, which is kind of the TSMC of China. They're quite a bit behind TSMC, unfortunately, for those companies. So we'll see whether they're able to make progress. I mean, the argument from Jensen Huang and David Sachs in the White House is they're going to be forced to catch up on the domestic front if we don't supply them some of these chips, and that would taper their interest in buying domestic chips.
Well, Peter, thanks so much, as always, for joining us. Peter Elstrom, they're our executive editor for Global Technology. Now, Californian auto regulators are poised to suspend sales of Tesla vehicles for 30 days if it doesn't change its marketing practices that allegedly misled consumers. The California Department of Motor Vehicles accused Tesla of exaggerating the capabilities of its autopilot and full self-driving software. The agency said the suspension will not take effect for 90 days to give the company time to appeal or come into compliance. And UK inflation slipped to its lowest level in 8 months in the year to November, a bigger than expected drop. Let's bring in Ven Ram, cross-asset strategist for Bloomberg Markets Live. Ven, thank you, as always, for joining us. Does this data from the UK actually solidify market positioning for a rate cut tomorrow by the BOE?
Morning, Francine. Pleasure to be talking to you. I think it's absolutely nailed on a rate cut tomorrow because it has indeed solidified market pricing. The markets were thinking about 90% chance of a rate cut before today's data, and today's data has meant that they're all but pricing in a full rate cut from the BOE. What will be interesting from the BOE, assuming we do get a cut, it's not a given. If we do get a cut, I think the margin of vote will be of crucial significance to the markets. And if last month we got a 5:4 vote against a rate cut, this time we may get a 5:4 vote for a rate cut, or 6-3, or even a 7-2. A 7-2 would obviously be extremely bullish for gilts because that will cause the markets to front load some of the rate cuts in the that are remaining in the cycle, and also to probably factor in a lower terminal rate, even though that lower terminal rate may not kind of morph into reality later on. I think that the terminal rate is still around 350, so the markets should be gearing up for that.
Yeah, meanwhile, we've seen a cooling of the U.S. labor market. Where then does this leave the Fed looking into 2026?
I think the markets are pricing in two rate cuts and a bit more. They're not fully certain about a third rate cut, but I think considering what we are going to get in terms of a Fed chair who is going to be dovish by the nature of his job description, at least by what White House wants, I think that is going to be written into his job description. And that means that we should be prepared for more rate cuts, even though core inflation is sticky around 3%. I think that the market should be wise to kind of factor in more rate cuts rather than fewer rate cuts.
Then what else are you looking to until the end of the year? I know it felt like last week was certain who the next Fed chair was, and now there's a number of interviews going on with the president. And so I don't know whether that means that it's just a way of President Trump to keeping it in the limelight, or whether we could see a surprise, new Fed chair.
Well, I think that, I think that we are likely to get one of the Kevins as the Fed chair. I think the interviews notwithstanding with Christopher Waller, I think that's a bit of a red herring. I think that the markets are kind of, should probably bet on, at least I would bet on Hassett becoming the next Fed chair. I think that what is even more interesting from the Asian perspective going into 2026 will be the Bank of Japan, Francine. I think that they are expected to raise rates on Friday, but of crucial significance will be the guidance. I mean, the BOE is the BOJ has been kind of dragging its feet over further rate hikes and further tightening, but given how far behind they are on the fight against inflation, I think that if they are emboldened enough to suggest that they are going to go at a faster pace, I think that will be hawkish for the markets and cause JGBs to sell off.
Ven, thank you so much. As always, Ven Ramder, across asset strategist for Bloomberg Markets Live. Now, this is a picture across the board. Look, oil definitely left, right, and center. Oil advancing after President Trump ramped up pressure on Venezuela. We're also looking at gold actually rising, pushing it close to the record set back in October. We did have that jobs data in the U.S. that did little to strengthen the case for further Fed interest rate cuts. And then a couple of the other things we're watching out for across the board is, of course, 0.3329. Up next, a Bloomberg Brief, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing because I never watched the movies. I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade, weekdays only on Bloomberg TV. context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Ramping up pressure, oil rallies as President Trump orders a blockade of sanctioned oil tankers going into and leaving Venezuela. Fresh curbs. The U.S. is said to be preparing a new round of restrictions on Russia's energy sector if President Putin rejects a peace deal with Ukraine. And a win for Amazon. OpenAI is said to be in talks to raise at least $10 billion from the online retailer and to use its chips. Well, checking in on these markets, we have futures pointing higher stateside a touch. Not much market reaction yesterday after that jobs data. Let's be honest, there was something in it for both the Hawks and the Doves. Treasury yields are looking pretty steady, higher 2 basis points across the curve. The 10-year is currently at 4.16%. And we have major moves when it comes to the oil market. Both WTI and Brent up on this U.S. blockade of Venezuelan tankers and the U.S. preparing Russia sanctions if there's no peace in Ukraine. More on that in a moment. But for now, cancelling out that downward pressure from the oversupply concerns. And gold there also flirting with the record set in October. That's $4,381 a troy ounce. We're not quite there yet, but that on the safe haven demand. Now let's get to our stocks to watch. Here's Valerie Teitel. Good morning, Lizzie. Let's start with what's going on in the media space, this media merger frenzy. We've had news from the Wall Street Journal that the Warner Brothers board is preparing shareholders to reject the Paramount Skydance deal. So we're seeing shares of Paramount in the red, down 0.7%. It's a double whammy of negative news for Paramount Skydance. We also heard that Jared Kushner's fund, Affinity, is pulling equity that it did pledge the Paramount deal. So we're seeing shares of Netflix rise off the back of this. Remember, they are the other suitor in this hostile takeover. And Warner Brothers Discovery shares down 1.2% off the back of that as well. Well, let's move on to the airline industry. Some news here. We have Spirit Airlines in talks with Frontier on a potential merger that could save Spirit Airlines from insolvency. We're seeing shares of Frontier leap near 5% higher in pre-market trade. Lizzie, a combined Frontier Spirit Airlines would rank the 5th largest in the U.S. if this deal was to come to fruition. All right, Valerie, thank you so much. We've got one more. Just to check on the oil majors, Lizzie, I just want to mention they are some of the biggest gainers in the Euro Stoxx 600 this morning. This is on the back of oil rising from those year-to-date lows. We're seeing the likes of Shell up nearly 2% and BP here listed in London up 2.5%, lifting the FTSE this morning. These oil majors are really carrying the Euro Stoxx 600 higher in Europe. Oh, perfect. Well, we're going to dive into that theme more throughout the program. Valerie, we'll see you later on in the hour. And coming up in this hour, we're going to be speaking to Kayla Cedar of State Street as stock futures rebound after a 3-day slump. But first, let's get back to that oil rally rising on geopolitical risk. Bloomberg's Will Kennedy's following President Trump's order of a complete blockade of sanctioned oil tankers in Venezuela. And we've got Oliver Crook tracking the developments on the latest sanctions on Russia's energy sector. So, Will, let me start with you. What does President Trump actually want from Caracas? It's not clear what land and assets he's accusing Venezuela of stealing.
Well, I think ultimately the Trump administration appears to want a change of regime in Caracas. He is interested in the oil that Venezuela has. I think he probably sees that as an opportunity. So he has ratcheted up pressure on the regime, and we've seen that in a number of ways through these strikes on boats that he claims are exporting drugs from Venezuela, through sanctions, and now seizing that tanker last week, and now this wider blockade of oil exports from Venezuela. He's clearly trying to squeeze the Maduro regime economically.
Of course, Venezuela is an OPEC plus member, but how much of the oil market does Venezuela have?
It's not a huge player anymore. We've seen over the 25 or so years that we've had this socialist government in Venezuela that it's role in the oil market is steadily diminished, and right now it's only exporting about 500,000 barrels of oil a day, and that's in a context of global oil demand of more than 100 million barrels a day. So it's become a fairly marginal player, but that's not to mean that it couldn't be significant again in the future. It's sitting on top of some of the world's most enormous oil reserves, and with international investment, with a less politically manipulated oil industry, it could probably increase production again. And I think that one of the things that the Trump administration, sees there is the opportunity to play a part in the revitalization of the Venezuelan oil industry.
Okay, well, we'll stay with us. Ollie, I want to bring you in. What are the sanctions on Russia likely to be that the US is threatening?
Yeah, so there's been a lot of question about how the Trump administration is going to bring Russia to the negotiating table if there is a failure on the Russians to agree on this sort of intense peace proposal and negotiations we've got from the United States over the last couple of weeks. We know the pressure that they're willing to exert on the Ukrainians. It is fairly easy for them to do so because of the dependencies that Ukraine and the Europeans have on the United States, but it has been less clear until today what they are considering doing to the Russians. And what we understand is that the Treasury and the U.S. are thinking more broadly about adding additional sanctions on the Russians if they fail to come to the negotiating table, if they reject what the U.S. considers to be a reasonable proposal, and that could be additional measures on the Russian shadow fleet, on the high seas, and as well on some of those that are trading oil and natural gas, or I should say oil and other potentially fossil fuels on the Russian side. That would, of course, try to put more constriction on the revenue that is driven a lot by the fossil fuels for the Russians, and that is, of course, what is funding the war machine in Russia. So it's seen as really quite potentially consequential, particularly from the European and the Ukrainian side, because there's been a lot of question about whether or not Trump is willing to move any further. But it does fall short, Lizzie, of those massive sanctions, the ones that have been put forward by Lindsey Graham that do have bipartisan support in the Senate at the United States, and those are the secondary sanctions. That would be really the kind of nuclear option to going after the sort of the countries that are still buying Russian crude oil. This would be massive tariffs that the United States would impose on third-party countries like China and India and others who still buy Russian crude oil. We're still talking something that is quite short of that.
So the question becomes, Ollie, how likely all this is to bring President Putin to the negotiating table. Trump, of course, hoping for a ceasefire by Christmas.
Yeah, well, listen, I think we're not quite there yet. We haven't had quite the reaction from the Russians on the latest slew of negotiations over the last couple of days in Berlin. Of course, the Europeans were talking very positively about it. The Ukrainians were as well. There's still a lot of outstanding issues, particularly on the concern of territory for the Ukrainians, but we have not got a reaction yet from the Russians. We had some sort of comments from some sort of less senior foreign emissaries within Russia that were making sort of positive noises, but we need to get the full readout of the reaction of that 20-point plan from the Russians, which we have not got yet. That being said, we should say that just a couple of weeks ago, those sanctions on Rosneft and Lukoil went into power. That is a way that is putting a little bit more long-term pressure on the Russians. And we should say that in terms of the barrels of oil, we're talking about Brent today that are about around $60, and that, you know, coming down significantly over the last couple of months. For the Russians, they're only getting about $40 a barrel for a lot of what's being traded on the high seas, and that's come down about 30% over the last 3 months. So there is pressure from that side of things that is being exerted on the Russians. We'll see if it really comes to bear in the negotiating table.
So will Brent at $60 a barrel now, but it had been 55 yesterday on WTI. So then what happens if you take out the Venezuela story and focus on the Ukraine story? Where's the floor?
So as Ollie's just described, we got these use of sanctions by the Trump regime. He's very keen to use energy sanctions to try and get what he wants politically around the world, and that does, at the margin, exert some upward pressure on prices. But I think the broader background is that we're in a market currently which is oversupplied. We are producing more oil than the world is using every day, and we're seeing that surplus build up on oil tankers around the world and on storage tanks. And I think we see a bit of an uptick today, but the longer-term story into the middle of next year is broadly bearish. And I think the other way to think about it is, in both situations, if Trump gets what he wants, i.e. a new government in Venezuela and a peace deal in Ukraine, both of those things could ultimately be bearish for the crude oil price, because you've got a Venezuelan oil industry that's now free of sanctions with the prospect of American investment, and you've got probably the roll-off of some sanctions on the Russian oil industry. So in the short term, you're seeing that uptick. I don't think it's doing much to change the longer-term picture.
All right, let's see how much of Trump's Christmas list he actually gets. Bloomberg's Will Kennedy and Oliver Crook, thank you both so much for your analysis. Now let's get to some other top stories trending on the terminal this morning. UK inflation slipped to its lowest level in 8 months. Consumer prices rising 3.2% in November after a 3.6% increase the previous month. The figures have prompted investors to ramp up bets on lower borrowing costs. Traders now see the drop as all but sealing a rate cut when the Bank of England meets tomorrow. Elsewhere, Tesla sales in California are poised to be suspended for 30 days if it doesn't change its marketing practices. According to the state's motor vehicles department, Tesla's allegedly misleading consumers about its driver assistance technology. The suspension won't take effect for 90 days to give the company time to appeal or come into compliance. And SpaceX has told its employees that the company is entering a regulatory quiet period, taking the company a step closer towards an initial public offering slated for 2026. According to sources, employees were told to refrain from commenting on the company's IPO plans, including topics such as its growth or valuation. A quiet period for Elon Musk, imagine. Well, coming up on the programme, OpenAI in talks to raise at least $10 billion from Amazon. I'll bring you more on that next. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
This is Bloomberg Brief. I'm Lizzie Burden in London. Now, OpenAI is in initial discussions to raise at least $10 billion from Amazon. Bloomberg sources say that the deal under discussion could value OpenAI north of $500 billion and see it adopt Amazon's Trainium chip. Bloomberg's Peter Elstrom joins us now for more. Peter, another potential mega deal here involving OpenAI. How significant is it for some?
Yeah, so many deals in AI these days. It's a big deal both for OpenAI and for Amazon. Again, it's preliminary talks. We don't know whether it's going to go through at this point, but it is a big deal. First of all, for OpenAI, we've seen Sam Altman and OpenAI diversify their bets both on the chip front and on the data center front in a number of different ways. You'll recall it's not that long ago that they only used NVIDIA chips and they were only working with Microsoft as their data center provider. They'd gotten investments from Microsoft. On the data center side, we've seen them diversify. They're using Microsoft and Oracle and SoftBank so that they have some options within that area. On the chip front, they're trying to do something similar, although it's harder because NVIDIA has such a lock on AI chips at this point. So they're primarily using NVIDIA chips. They have said that they're going to use AMD chips, and now they're in these discussions with Amazon to be able to use their chips within their data centers too. It gives them some options in terms of suppliers. It probably brings down the cost a little bit, and it gives them a little bit more potential going forward.
So then what does it mean for Amazon and its long-term chip strategy?
Well, Amazon is interesting. Amazon, of course, effectively invented the cloud computing business. They're the leader in that field. But as we've transitioned from traditional cloud computing into AI cloud computing, they're a step behind. They've been losing out a bit to some of these other providers, including Microsoft has a lot of momentum. Oracle now actually has a lot of momentum too. They would like to be able to use these Trainium chips that they've been building internally to be able to compete on that AI cloud computing front. So this would be a bit of a validation for them if they can get OpenAI on their side to use those chips.
Okay. Also, we've got to talk about the fact that there is yet another billionaire coming out of Chinese chips. Tell us more about MetaX and its founder.
Crazy. Yeah, MetaX, not to be confused with Meta in California. MetaX in China went public. Their stock went up almost 700% in the local market there. The valuations at these companies are getting a really incredible. MetaX's valuation now is $47 billion. It's not a small company. And this, as you were referring to, this comes just shortly after more Threads went public, and their valuation is about the same, almost $50 billion. So these are pretty big companies. Say there's a lot of retail investor excitement around the AI investment opportunities within China. Yeah. They know that the Beijing government is keeping out NVIDIA chips and some of the competition right now. They also know that a lot of money is going to be spent on this front, so they see opportunities in front of them. The valuations, again, are a little dizzying at this point, but they're getting a lot of momentum.
So how does that compare then with the AI story in Europe and the US?
Well, in the U.S., NVIDIA is certainly far ahead. AMD is far ahead of these companies. They also have their chips made by TSMC, so they have much more sophisticated manufacturing. In China, they need to lean on SMIC primarily to be able to do this, so their chips are not as sophisticated, their designs aren't as sophisticated, but they have support from the local companies, and they have support from the local government, so there are some opportunities to make some money.
Okay, really fascinating. Joining the dots for us, Peter Elstrom, we thank you as always. Now, in other deal news, Jared Kushner's Affinity Partners is exiting the takeover battle for Warner Brothers. Let's get more now with Bloomberg's Manuel Baigorri. Manuel, good to see you. We've got Kushner's Affinity Partners exiting, as I say. It's no longer backing Paramount Skydance's proposal. Why is Kushner pulling out?
Exactly, Lizzie. It's another step in this saga. It's quite a drama, but exciting, obviously, to watch us. It's a very transformative move. The latest, as you said, Lizzie, Affinity walking away from Paramount's bid. Obviously, it's another blow politically and financially for Paramount's chances to get this successfully done. But at the same time, we understand from sources that Warner Brothers is about to reject publicly Paramount's bid and also urge shareholders not to tender the shares in the hostile takeover offer. So yes, a very significant move by Affinity and Jared Kushner walking away from the deal at this very critical junction right now. But itself, the deal became very, very controversial, very political. So there is also clear reasons why he might have decided to, not participate on this transaction anymore.
So they're Kushner's reasons, but what about the reasons for Warner readying its rejection of Paramount's hostile bid? What do we know? Is it just about the money?
Yes, mostly. I think there is the money, as you said, the financing, the terms offer. I think there was a little bit of concerns about the structure around the financing package and whether or not that could backfire, down the line. But obviously, I think there is an agreement in place with Netflix, which Warner Brothers believes provides more value over time strategically, and that they feel apparently more comfortable with, even if on paper, theoretically, the two different proposals, right? One headline number might be lower than the other, but also the structures are different. So kind of like different bids on the table. But yes, definitely the financing and the terms offered by Paramount were a big concern behind this reasoning.
So Netflix up in the pre-market, Manuel. What more do we know about what they'd actually do with Warner? Obviously, concerns about the end of cinema, perhaps.
Yes, definitely. I mean, they're going to get a lot of market share, right, in streaming. So Netflix has been very, very successful. They obviously are the clear dominant. And by also getting potentially HBO, that may also raise questions in terms of antitrust. Remember, even Donald Trump said that he would personally get involved in the review of this transformative deal for the industry, not just in the US, but also globally will have ramifications. So it is clear that antitrust will raise some questions there, and that people will be very, very closely watching this transaction, whether or not it will get materialized. But I think more imminently, we might see something more formally from Warner Brothers potentially rejecting or urging shareholders to reject Paramount's bid as soon as today.
Okay, we'll keep an eye on it. Bloomberg's Manuel Baigorri, we thank you for the latest on that deal. And coming up on the brief, police charge alleged Bondi Beach attacker with 59 offences. More on that and a look at what else is making headlines on your front page news next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Time now for your front page news. First up on the BBC, the surviving suspect in Sunday's mass shooting at Bondi Beach, Naveed Akram, has been charged with 59 offences. The charges include 15 counts of murder and committing a terrorist act. His father, 50-year-old Sajid Akram, was killed in an exchange of fire with police. Next up, we turn to the New York Times. A person close to the Reiner families provided a detailed account of events that occurred before and after the killings were discovered. Nick Reiner has now been charged for murder over the deaths of his parents, Hollywood director Rob Reiner and Michelle Reiner. The person close to the family said that nothing in recent weeks suggested that Nick would be capable of such violence. Finally, we turn to the Financial Times, and JP Morgan withdrawing almost $350 billion in cash from its account at the Federal Reserve since 2023. Much of that money was used to buy US government debt, the move allowing the bank to lock in higher yields in anticipation of rate cuts. Just quickly checking in on your markets, we have futures pointing higher into today's session following the gains in the European session that we've seen already. The dollar up 0.3%, and you're looking at the 10-year up 2 basis points. Similar moves across the curve, but the real action is in commodities. You've got major moves in oil this morning, both WTI and Brent up on both the US blockade of Venezuelan tankers and the US preparing Russian sanctions if there's no peace in Ukraine. So more on all of this, but cancelling out the downward pressure from the oversupply concerns. Gold there also up about 0.5%, just shy of a record. The record is $4,381 a troy ounce. We're not quite there yet, but we are seeing that safe haven demand. Silver already having hit its record. Coming up on the brief, stocks climb, the dollar rebounds from its 2-month low, and we'll catch up on all of that with Kayla Cedar of State Street on investors' risk appetite heading into 2026. That's next. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
From the world of politics politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden in for Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Ramping up pressure. Oil rallies as President Trump orders a blockade of sanctioned oil tankers going into and leaving Venezuela. Fresh curbs. The U.S. is said to be preparing a new round of restrictions on Russia's energy sector if President Putin rejects a peace deal with Ukraine. And a win for Amazon. OpenAI is said to be in talks to raise at least $10 billion from the online retailer and to use its chips as well. Well, checking in on these markets, and we have U.S. futures pointing higher as we head towards today's session, tracking the gains that we've already seen in Europe. And after yesterday's jobs report was pretty meh, to be honest. Something in it for the Hawks and the Doves, delayed and deeply flawed technically as expected. But if we look at the Treasury picture, we've got yields higher across the curve by about 2 basis points. You're looking at the 10-year there at 4.16. And really, the major moves today are in commodities. Take a look at the oil space. We have Brent there at $60 a barrel now. We've seen gains, as I say, because of this blockade of Venezuelan tankers and the US preparing Russian sanctions if there's no peace in Ukraine, cancelling out the downward pressure from the oversupply concerns. But gold there as a safe haven, drawing attention, up 0.4%, but still just shy of its record. Let's get to your stocks to watch now. Valerie Teitel is back with those. Val. Good morning, Lizzie. Let's start with a check on the drama in the media space. It appears that Paramount might be out of the takeover race for these Warner Brother assets. We're seeing shares of Netflix up 1.8%. Warner Brothers Discovery in the red, down 1.3%, as we're likely going to lose Paramount as a suitor. Not only is Jared Kushner's Affinity Partners pulling equity from the deal, but it has been said that Warner Brothers board is going to be recommending shareholders to reject Paramount Skydance's offer. Are we going to get a deal on this side of Christmas? Time, I guess, is on our side now. Let's move over to the airline industry. I want to talk about Spirit Airlines, the deep discounted airline, might be saved from insolvency. We're reporting that they're in revived talks with Frontier Airlines on a potential merger. We're seeing shares of Frontier jump near 5% in pre-market trade. Lastly, I want to check on the oil majors. One of the big movers in the European session to the upside. We're seeing oil rebound from year-to-date lows off the back of news of this Venezuela blockade, plus U.S. threatening more sanctions on Russia if no peace deal comes to fruition. We're seeing shares of Shell jump over 2% and BP up nearly 2.5% in the trade in London. Lizzie? Valerie, thank you so much. Now to the broader market. State Street's Kayla Sader weighing in on markets' risk appetite as futures bounce back after a 3-day dip in the S&P 500. She writes, quote, although turbulence may remain elevated and concentration risk will remain high, we don't see major red flags on the liquidity or credit fronts. This means we are still in a buy-the-dip opportunity. And I'm pleased to say that Kayla joins us now for more. She's the macro multi-asset strategist over at State Street. Good to see you, Kayla. How big do the dips have to be viable then?
Hi, Lizzie. Thank you so much for having me. So yeah, I do think there's a lot to be optimistic about, and I do think risk appetite will pick up into the new year for a couple of reasons. One is that when we look at credit conditions still look okay. The second thing is when we think about liquidity still looks to be okay. I mean, at the last FOMC meeting, we had the Fed come in and say, hey, we are going to buy bills to ensure liquidity and reserves remain ample. So that's a good thing for overall market functioning. Additionally, when we look at things like turbulence and systemic risk, our measures of systemic risk still remain relatively low. Turbulence has picked up a little bit, and this could continue, and I think this kind of reflects some of that concentration risk. But when we look at where that concentration is concentrated, it's really heavy in high quality parts of the market. And so I think that's going to continue moving forward. And so when you take all of those factors together, I think we're in an environment that's still very resilient for risk.
And if we go back to the US economic data yesterday then, Kayla, we had something in it, as I say, for the hawks and the doves. Anyone can illustrate their argument as they please. Did it change your view for Fed cuts next year?
Yeah, I think, like you said, there's kind of something for everyone in the data we got yesterday. It doesn't materially change my view. I do think we're in an environment where it's prudent for the Fed to maintain on hold for a little bit. And part of that is because when we look at the labor market data, for example, it didn't provide a lot of clarity. You still see issues with demand, but you also see issues with supply. And so I think what that means is, let's take a step back. The Fed did just ease a total of 75 basis points over the last couple of months. Let's see how that feeds through into the economy, especially because inflation is still elevated. So I think the Fed just wants to wait and see, how is the labor market developing, especially once we start to get further out of this lack of official data fog.
So given how flawed that data is and delayed, is it the case that actually the race to become the next Fed chair and the Fed speak is going to be what dominates markets' minds in the short term? We know that Chris Waller is going to see the president for his interview now.
Yeah, I think Fed speak is really going to be what's driving markets in the short term. We've seen this a lot around headlines around who could be the next Fed chairman, and I think that's going to continue moving forward. I think one thing that's important to consider too is what is the makeup of those regional Fed presidents, and how hawkish or dovish could that tilt shift? And one thing that we've seen is we expect kind of this more hawkish tilt from Fed presidents to continue into 2026 because you have Hammack and Logan that are joining and swapping out Schmid and Mussolem. And so you still have kind of more hawkish folks that will be voting next year. Now, what has driven kind of this divergence between the board being less hawkish relative to regional members, and that driver has really been inflation. And so I think what's really important when it comes to Fed speak is thinking about what is happening with inflation and what is happening with inflation expectations. If inflation expectations begin to rise, I would expect more of that division to continue or even make the Fed a lot less dovish.
Okay, so you've still got the counterweight of the hawks, but out of the three, the Kevins and Waller, who's got the most credibility in markets?
I think all of them are qualified. I think it's hard to make a case that they're not. I think Waller and Warsh, they do have a lot more experience at the Fed. I think one thing to consider too with a Warsh is you could be in an environment where you could have a stronger dollar because he's considered a bit more hawkish than the other options. But with that said, I think the overall expectation continues to be that we'll be in an environment where the Fed's next move is going to be a cut, no matter, which of those three are running the Fed.
But let's say the Fed doesn't cut as much as the market expects. How much would that hold back US stocks?
That's a great question. And I think that's where that concentration really comes into play and where that allocation comes into play. Because if allocation was in very rate sensitive parts of the market, I would be a bit more worried because we think, the Fed is in a good place to stay on pause for a prolonged period of time. That's not the case, though. Allocation is towards really strong sectors that have less interest rate sensitivity. And so I think that can really underpin the U.S. market from here, even if we don't get Fed cuts as early as the market expects.
And in terms of the AI theme, beyond big tech, who do you expect to see benefiting from AI first, and when does that actually spread out and broaden?
Yeah, that's a great point, because I think this AI theme is going to continue for a while, and it's going to continue to be a factor in growth more broadly. We heard Chairman Powell even mention AI and AI growth in a driver of GDP, and how the Fed increased their GDP forecast, not just on consumer spending, but also on AI investment. And so I think it can be this tide that slowly lifts more and more boats. A couple of places where we're looking at that now are places like utilities, places like industrials, very much so tied to the build out of AI. But there's other options too, potentially in places like healthcare. Now, healthcare has been really interesting lately in our data because it had been the most underweight sector in our data set. And we started to see a lot more buying within that healthcare space. Now, I don't think that has, I think that's more to do with positioning than it does with AI. But I do think that was perhaps an underappreciated part of the market that does have more opportunity for net upside and is not a very crowded trade from here.
Okay, lots of optimism there. Kayla Cedar of State Street, we appreciate it as we end 2026. Good to see you, thank you. Well, now to some other top stories trending on the terminal this morning. Jared Kushner's Affinity Partners is exiting the takeover battle for Warner Brothers. The move comes as Warner plans to reject the Paramount Skydance bid that his private equity firm backed. According to sources, the involvement of Kushner, who is, of course, President Trump's son-in-law, drew a lot of unwelcome attention. President Trump had said that he would personally review the deal. Elsewhere, SpaceX has told its employees that the company is entering a regulatory quiet period, taking the company a step closer to an initial public offering slated for 2026. According to sources, employees were told to refrain from commenting on the company's IPO plans, including topics such as its growth or valuation. And we'll be watching the year's biggest IPO. Medical supplies manufacturer Medline priced its shares near the top of the marketed range. It sold over 200 million shares for $29 each, giving it a market value of about $39 billion. Well, coming up on the program, oil extending its rally as the US ramps up pressure on Venezuela and on Russia. More on that next. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies. The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Geopolitical tensions mounting worldwide as President Trump orders a blockade of sanctioned oil tankers going into and leaving Venezuela. The Venezuelan government responding in a statement, writing, Trump intends to impose in an utterly irrational manner a supposed military blockade of Venezuela with the aim of stealing the riches that belong to our homeland. Oil rallying on the news. So let's get more now from Washington with Kate Ackley of Bloomberg Government. Good to see you, Kate. Just talk us about how that pressure on Caracas is likely to escalate.
Well, this is obviously an idea that would escalate the pressure on Venezuela. And you're seeing that, come from Washington as the military presence is, also building in the region. So this is one piece. This is sort of the economic piece. And then you also have the military might piece going on as well, all aimed at ratcheting up the pressure there on Venezuela.
And in another escalation, you've got the US preparing a fresh round of sanctions on Russia's energy sector to push President Putin, of course, to the negotiating table. How stringent could those sanctions be?
Well, we might see those unveiled as soon as this week, if that does go into place. Again, this is all in pursuit. President Donald Trump is trying to sort of broker a peace deal there in Ukraine, between Ukraine and Russia. And this is yet one more piece in that puzzle of, trying to lean on Russia. Russia obviously is not going to be happy with this, but these early reports indicate that could be quite stringent, targeting Russian oil.
Yeah, we just have a line crossing from Italy's Giorgia Meloni, the Prime Minister there, of course, speaking to lawmakers ahead of the EU summit. She says that the US and the EU should work together to reach peace in Ukraine. So, of course, the president adding his pressure in the form of those sanctions, and we'll see what they will be. But we're going to hear, Kate, from the president himself later on at 9 p.m. Eastern time. He's going to deliver a prime time address. I wonder what he's going to be saying.
Well, we saw last week with the rally in Pennsylvania, sort of this official or unofficial kickoff to the 2026 midterm campaigns. And so this is the president's opportunity to sort of speak directly to the American voters, the American public, talk about what the successes are of his agenda this year in 2025, and then look ahead to 2026. And the midterm campaigns, what's going to be on voters' minds, still rising costs or just the continued high cost of living that a lot of voters say that they feel in polling and other things. But expecting President Trump to really, take credit for wins of this year, talk about the things that he and his administration are going to focus on in the new year as the midterm campaigns really, really notch up here in the United States.
All right, a victory lap for the president. 9 p.m. Eastern time. I'm sure we'll be watching closely. Kate Ackley of Bloomberg Government in Washington, we thank you. Now, let's turn to tech. Amazon rising in the pre-market. Bloomberg learning that OpenAI is in early talks to raise at least $10 billion from the online retailer. The deal under discussion could value OpenAI north of $500 billion and see it adopting Amazon's Trainium chip. Well, Bloomberg Tech Europe anchor Tom McKenzie joins me now for more. Tom, just how significant is this deal for OpenAI?
Well, it's a reminder that there's a couple of key things that continue. One is OpenAI, which is going through this red alert moment in trying to catch up with Gemini 3.0, which has had a lot of success and is being adopted very quickly. When I say catch up, I mean holding their market lead versus Gemini 3.0. And the fact that they will continue these investments and these deals to fund the build out of the infrastructure they think is needed to continue to innovate and develop and scale these models to the kind of point where they want to get them to. So $10 billion US, not insignificant even for a company like OpenAI that is raising hundreds of billions from various different partners. And it's the partnership, to your point, and the use of Amazon's chips that is significant as well. So it's also an OpenAI that is looking to diversify away, to some extent, from NVIDIA Really, really interesting in terms of the complexity of the relationships, given that Amazon was an early backer of Anthropic, which is a big competitor to OpenAI, particularly when it comes to enterprise large language models and chatbots. And then, of course, the fact that Amazon itself competes very, very directly with Microsoft, particularly in the cloud space, Microsoft having that 27% stake in OpenAI. So it's a reminder of a couple of things. One is OpenAI is not walking back from its commitments in terms of raising new capital as it burns through cash at a rapid pace and is not going to be profitable, at least for a number of years. And it's a reminder as well that there are new chips now in the market, and that could become more of a theme in 2026.
Okay, and potentially really crucial for Amazon's long-term chip strategy as well. I also have to talk to you about this new billionaire that's emerged out of Chinese chip making, because of course you also spent a long time in China. Tell us more about Meta X and its founder.
National champions, and that is the focus. And investors are rewarding companies that lean into Beijing's policy around national champions, particularly in the semiconductor space. Any company that is even getting close to taking market share from NVIDIA will be rewarded, and we had a reminder of that today. So Meta X soaring around 700%. They raised whopping. I mean, it's like head spinning, and you do get a bit of a herd mentality in China around these IPOs, and they are slightly restricted. So the pipeline of IPOs has been curtailed by authorities for various reasons, and so that has pushed up the price as well. It's been one factor, but the key driving factor is this is the kind of company that is, from investor perspective, well positioned to potentially kind of close the gap. Their latest chip, they say, is just close to the H100, NVIDIA's H100, not far behind NVIDIA's H100, which was just a couple of generations behind the kind of GPUs that NVIDIA is putting out right now. And the former executives, three key founders of Meta X over in China, formerly at AMD as well, which of course makes those GPUs and competes with NVIDIA. So they have that experience. They're taking it now and trying to build that in China, where they have about 1% market share, according to the prospectus.
The interdependencies in this world of AI, the CV crossovers just blow my mind. All right, Tech Europe anchor Tom McKenzie, we thank you so much. Now to the auto space, the California DMV warning that Tesla's sales in the state are set to be suspended for 30 days if it doesn't change its marketing practices. Let's get more now with Bloomberg's Craig Trudell. Craig, what's so wrong with the marketing at Tesla?
Yeah, this specifically has to do with autopilot and what Tesla has marketed as full self-driving. Both of those, their critics have long argued are misnomers. I think with autopilot, it's maybe less egregious an issue. With full self-driving, it's particularly been a problem in that what Tesla is selling is a system that enables, some automation of certain tasks, but you, the driver, are in control, are responsible for if it crashes. And so to call it full self-driving has been something that's been kind of a lightning rod for criticism for some time. And the California Department of Motor Vehicles has the ability to sort of weigh in here and has a means to sort of enforcing its view by preventing companies from being able to register new vehicles in the state. So that's why it's able to kind of come in here and exert itself after some time of investigation and deliberations with the company.
And of course we know that Tesla's in a race with Waymo, Craig. Waymo, Alphabet's autonomous driving unit, in talks to raise more than $15 billion, so near a $100 billion valuation. What would that money do to enable Waymo to compete better against Tesla?
Yeah, I think, Waymo has been playing a different game, right? They have vehicles that actually are capable of operating without anyone behind the wheel or without, safety operators in the passenger seat, even for Tesla in Austin, Texas. I do think, while they have absolutely made a lot of progress the last couple of years with deploying in more and more cities with these driverless vehicles, they have done so in a very sort of slow, deliberate, careful way. Some of that is likely due to safety concerns, but a lot of that also has to do, in all likelihood, with the economics of this robotaxi model not being there. So they need to keep raising money to fund that expansion.
All right, Craig Trudell, we thank you. Stay with us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Let me take you through what's on the diary today. We have Fed speak coming from Waller, Williams and Bostic throughout the day. Waller in focus, of course, because he's got an appointment with the president about potentially being the Fed chair. That interview later on. We'll also get earnings from General Mills and Micron. Plus, the president's going to address the nation at 9 p.m. Eastern Time. Checking in on what's happening in these markets, and we have to look once again at these oil markets. We've got Brent up 2.4% at $60 a barrel. Two drivers, the U.S. blockade on Venezuelan tankers and the U.S. preparing Russian sanctions if there's no peace in Ukraine. That does it for Bloomberg Brief. Surveillance is up next. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurants opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This year, it's all about single stocks. It's all about earnings, fundamentals.
For now, investors prefer to focus on AI.
We've got an AI-driven investment boom.
Tech leadership will continue to dominate, but alongside that, we believe you can see that broadening.
A key driver of returns in 2025 and likely in 2026 and beyond is going to be that core AI exposure.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks trying to find their footing after 3 straight sessions of losses. A new challenge to the rotation thesis coming down with oil prices surging from 2021 lows as President Trump orders a blockade of sanctioned Venezuelan oil tankers. And the tech money ball keeps on rolling with OpenAI and talks to raise $10 billion from Amazon and use its chips, the whole kind of vendor financing experience that we have seen this year. Damian Sassower back with us for the next 3 hours. Damian, it seems like we see a challenge right now to this idea of immaculate disinflation with just a touch of sense that maybe oil prices could start inflecting a little higher.
That's right. Commodity prices are ratcheting back up here. You see prices of gold and oil rallying, shares of BP and Shell are rallying overnight. So certainly the saber rattling by Trump is causing a bit of a stir here in European equities overnight.
So every time this happens, oil prices rise, treasury yields rise, and people say they shouldn't be rising because they're actually completely not related. And yet that is what ends up kind of forcing a new narrative onto markets. How much does that potentially challenge some of the aspects of disinflation that we've seen so far this year?
I don't think so much. I mean, Venezuela only produces 1 million barrels per day. I mean, look, the reality is, you know, inflation, the supply-demand imbalance in the oil market is so much greater. I don't think inflation is going to take away all that much from the news overnight. But it's anyone's guess as to where we go from here. I mean, JP Morgan's looking for an average oil price in 2026 of something on the order of $50 to $55. We're currently at $58. So that's the direction of travel.
So maybe a head fake. Right now what you are seeing in markets is a little bit of optimism, although not coming from the place that it has been coming up till now for the past couple of weeks. It is led by big tech. People enjoy the circular financing, the vendor financing. Yay, bring it. S&P futures up 0.3%, a bit more of a pop in NASDAQ futures. A little bit of dollar strength. Honestly, euro dollar has been in this 117 range for so long. It seems like it's just pegged here. Yields slightly higher on the heels of higher oil prices, up 3 basis points to 417. And you do see crude popping 2.3%, but that is off the lowest levels that we've seen since 2021. Then it's on to CPI tomorrow, and of course, a big address from President Trump later this evening. Coming up this hour, Stephen Auth of Federated Hermes, as stocks look to snap a 3-day slide. Elizabeth Economy of the Hoover Institution on what's next for U.S.-China relations. And Veronica Clark of Citigroup looking ahead to CPI inflation data that we get tomorrow. Maybe that will give us some clarity that we did not get from yesterday's jobs report. We begin this hour with stocks edging higher, with investors awaiting a year-end rally that's yet to take shape. Where is Santa? Stephen Auth of Federated Hermes with a 7,800 price target on the S&P 500 for next year, writing, we remain pretty far out of dangerous bubble territory. We believe the market should broaden, and we are overweight stocks overall. Stephen joins us now. You also have a heady target for 2027. Thank you so much for being here. Always great to see you.
Thank you, Lisa.
So why do you push back so much against this idea of a bubble, saying it's not that there won't be a bubble, it's just that it's not dangerous yet?
Well, all our clients are asking about it, and it's all the news. And, you know, unfortunately, I've lived through many bubbles. The Nikkei bubble, the Southeast Asia bubble, the TMT bubble, the real estate bubble in 2007. And, you know, my experience with those has been, it's been a multiple of factors that kind of define a bubble. And too many people these days are launching on one or two of those. And if you look at all the great bubbles over time, it tends to be about 6 different things that more or less occur. And they've got to kind of conjoin together. All bulls eventually end in a bubble. It's just a factor of once everyone gets on board, then the story starts to feed on itself, and it goes to excessive levels. But this one here, in our view, we've set up this bubble monitor for our clients, and we got it up on our website there, and it basically is highlighting in color, green, yellow, red, where we are on the 6 factors. And things like overinvestment is a big thing. We got that at yellow right now. You could make a case, perhaps, for that. Policy errors, not really. We've got a supply-side-driven policy on the fiscal side that is actually anti-bubble, if you will. The Fed is still, at least in our view, we've been saying all along, the Fed's too tight. We've got Fed bringing rates down to 3 over the next year. Whether they do it in January or March, I don't think it matters so much that we're heading to 3. But for now, rates are really too high. Excessive valuations usually are part of what you see in a bubble. We're nowhere near there right now.
Okay, so all of this sounds good. Part of the problem that people have is they understand that the excesses can and probably will get more extreme. At the same time, when you see vendor financing, circular financing, there was a chart that was just fabulous in a story this morning from Bloomberg, where it was just a circle with lots of arrows going back and forth with each of the big tech players. At a certain point, something smells a little rotten. Something is going to be not totally kosher when you get to the end of the day. How do you invest knowing that some of this has never ended well in the past?
Yeah, there is some circular financing, but remember, the people doing the financing have established businesses that are throwing off enormous cash flow and are growing at double-digit rates. So it's not like you're dealing with a phantasm here. We've never seen something like this. You've got these giant companies that are throwing enormous amounts of cash, and that's the cash that's underneath the circular financing. I'm not saying it's an easy thing to digest, but for now, at least, we don't think we're near, a kind of hyper speculation level that you'd see in a real bubble. And our own view is on the Mag 7. They are the core of this era, if you will, this industrial revolution. But we're being selective there, and we think the market is too. I mean, if you look at some of the big players in that space, they're not trading at excessive valuations. And we think you can play relative value there. We were heavy in Google earlier in the year. We're Amazon now, I think, is the value play in the Mag 7. I think you can play it like that and then play the broadening out trade. The Fed, one of the things that a lot of people don't get is that the Fed doesn't really affect much of the economy anymore. It had a big effect when the economy was asset heavy. Yeah. And asset heavy means you got to finance. By the way, another aspect of this bubble is not a lot of debt financing, not a lot of excess liquidity. Margin levels are very low, as an example.
But Stephen, I'd like to go back to that and touch on that. You and the team have Federated. You mentioned 3% Fed funds by the end of next year. That's 3 more cuts. That's more than the market's currently expecting. Do you base that call on fundamentals, inflation, growth expectations, or is it more a function of the two Kevins, a more dovish Fed, Trump's impact on the Fed going through? I mean, what are your thoughts on being a little bit more dovish than the market here?
Yeah, look, we don't, Damien, we really don't care much about what the Fed says, honestly. They tend to be rear view data driven. Fine. We try to predict what the data they're going to look at looks like. And as I was about to say about the economy, the Fed, and a lot of people comment the Fed, the economy, et cetera. Most of the economy, the Fed doesn't affect. It's asset light. It doesn't actually need interest rates to finance itself. So it's only really now one sector of the economy, the regional banks, the housing sector, that's in a kind of recession because they are very interest rate sensitive. And so what we see here is in that sector, the Fed does need to cut. And we think, with the employment levels aren't going to pick up here. You've got that sector having probably relatively higher unemployment. The rest of the economy, you've got AI driving jobs down. You saw the jobs number yesterday. It's relatively flat, particularly if you take out the 60,000 that they say is overstated. You're basically at zero. So the Fed has every reason with that mandate to keep cutting. And the inflation rates, unfortunately, the established economists all keep predicting the inflation is going to come through, the tariffs, blah, blah, blah. Every single month, the number comes in under the consensus.
Well, Stephen, I mean, I love the tie. Merry Christmas. Is that a nutcracker tie? I mean, talk to us about the U.S. consumer, the state of the U.S. consumer as we approach the holiday season and into 2026. Do you expect the U.S. consumer to be as resilient as it's been in years past?
As a broad statement, yes. Right? You've got real wages are rising. On average, people's incomes are going up higher than the inflation rate. So, yeah, the consumer should be okay. We don't think it's a boom, but the consumer seems to be in pretty solid shape. And, you know, that's another aspect here of a market that looks pretty good to us.
You know, you're talking about the jobs number, and you were saying, look at that, and it shows how weak things are. 10 other people would say, look at how strong things are, because you actually saw the participation rate go up, and you saw more people come into the labor market, and that was the reason why the unemployment rate went up. How easy is it to have conviction about this rotation trade at a time of such incredible confusion, where we haven't gotten data, and the data that we have gotten has been just evidence for whatever your conviction was before it came out?
Well, Lisa, you know, we have a lot of soft data at Federated Hermes, right? We've got our like 160 investment people work with me. We're out talking to companies all the time. So we have a pretty good sense of what's happening in the economy. And what we're hearing and seeing is the economy is sort of marching along okay. People's spending plans are higher for next year. They're not planning on hiring a lot of people. So the job market to us is kind of a Goldilocks situation from a Fed perspective. Not too hot, not too cold. And so it's not falling out. I just came back from Europe. Europe's not that exciting, but the odds of a pullback there are low. If anything, you know, people's numbers are probably low relative to where they're going to be because you got a lot of stimulus coming in. Same way on this side, we've got, you know, as much as we're marching along here, we've got a lot of stimulus coming next year. The IRS checks, you guys have been talking about this, you know, could give some extra stimulus to the economy. And the productivity gains are going to be coming. I mean, look at the productivity increases here, right? You've got a flat labor market and GDP. We've got GDP at 3 for next year. I think the consensus is 2. But either way, you're going to have a pretty good lift in productivity. That's good for profits. Profits drive the stock market.
Which is the reason why you see 7,800 and the reason why a lot of people also are getting pretty bullish heading into 2026. Stephen Oth, you're going to be sticking with us, I'm very pleased to say. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. The U.S. is preparing a fresh round of sanctions on Russia's energy sector should President Vladimir Putin reject the latest peace agreement with Ukraine. The new measures could target vessels in Russia's shadow fleet of tankers and the traders who facilitate transactions, with sources saying they may be unveiled as early as this week. Meanwhile, the son of Hollywood legend Rob Reiner has been charged with first-degree murder in the deaths of his father and his mother, Michelle Singer Reiner. Nick Reiner was arrested Sunday night after his parents were found dead in their Brentwood home. The Los Angeles County District Attorney says prosecutors are still deciding whether or not to seek the death penalty. And the California DMV could suspend Tesla sales in the state for 30 days if the company doesn't change its marketing practices. The agency accuses Tesla of exaggerating the capabilities of its autopilot and full self-driving software. Tesla can avoid suspension by filing a statement that it will stop using the name autopilot to describe its technology. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, rising pressure on Venezuela.
We're dismantling the cartels very rapidly, and they are being declared enemies of the United States of America.
Joining us next, Bloomberg's Tyler Kendall and Will Kennedy to break down what's going on and what's at play. This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Let's try this again, and maybe we can get some gains. Right now, we are seeing stocks inflecting higher after 3 straight sessions of losses, up 1/3% on S&P futures. A brighter outlook potentially for an economy with a motley reading on the jobs report. Some people saying it's good, some people saying it's bad, leaving the Fed pretty much in the same place when it comes to the chances of cutting rates as soon as January. Euro dollar at that 117 mark, although today it is the euro losing ground versus the dollar, and 10-year yields inflecting higher 3 basis points to 417 on this. Crude prices surging 2.2% after reaching the lowest level since February 2021 on what's going on with a blockade potentially of Venezuelan oil ships. Under surveillance this morning, rising pressure on Venezuela.
Venezuela emptied their jails into our country, but others have also. We're going to start hitting them on land, which is a lot easier to do, frankly. But these are a direct military threat. We're dismantling the cartels very rapidly, and they are being declared enemies of the United States of America.
Here's the latest. President Donald Trump designating the Venezuelan government as a, quote, foreign terrorist organization and ordering a complete blockade of sanctioned oil tankers moving in and out of the country. Our team coverage starts right now with Bloomberg's Tyler Kendall and Will Kennedy. Tyler, I want to start with you. Do you have a sense of what the end game is, what the U.S.'s goal ultimately is with some of the military activity around Venezuela?
Hey, Lisa, good morning. Well, we had reporting from Bloomberg News last week that we would start to see this new phase in the United States strategy against Venezuela with the designed goal to have Nicolas Maduro relinquish power. And we're starting to see that new phase. It was kicked off last week when the U.S. moved to seize a foreign oil tanker for the first time since 2014. And now this latest round of escalation and this quarantine on sanctioned oil tankers from coming to or from Venezuela, just the latest escalation, and now targeting Venezuela's lifeline of oil revenue for a country that has already been struggling financially. Now, it's important for us to note that it's not totally clear how this blockade is ultimately going to be enforced or implemented, but we are already starting to see some intended impacts before, since the administration had telegraphed that it was coming. Just yesterday, we saw 4 oil super tankers that were headed to Venezuela ultimately turn around and reverse course. Now, the signals that we've gotten from the administration, I know you're going to talk more about this when it comes to the oil markets, but it appears White House officials aren't overly concerned what this is going to mean for the American consumer via potentially higher oil prices, just given that Venezuela's global output has fallen so sharply. I will say, of course, this comes against that backdrop that the U.S. has now built up its largest military presence in the region in really decades, as we have now confirmed more than 20 strikes against alleged drug trafficking votes, Lisa, in just the past few weeks alone.
Thank you so much, Tyler. And yeah, really on the story of supply and demand, Will Kennedy joining us. Do we have a sense of how much oil Venezuela has been producing, how much it could be producing, and whether this is a potential supply side shock down the road or potentially a demand side shock? In other words, is this going to be an issue of actually taking barrels off the market, or could this potentially lead to increased production in the not so distant future?
I think you're exactly right, Lisa, to focus on the divergence between the possible short-term implications and long-term implications. In the short term, as you and Tyler have both pointed out, Venezuela isn't currently a huge player in the oil market. We see its exports at just over 500,000 barrels a day, and in the context of a global oil market, which is 100 million barrels plus every day, that is a pretty marginal effect, especially at a time when most analysts will tell you that the market is heavily oversupplied. We've seen a steady slide in benchmark prices. Brent traded at below 60 yesterday for the first time since May. So I think this will disrupt exports from Venezuela and put all the financial pressure on the Maduro regime that Tyler described, but it will not have a huge market impact. We've seen a little bit of a tick up today, but that's in the context of a pretty bearish overall market. But as you say, Lisa, in the medium term, if we got a change of regime in Venezuela, and that opened the way to the lifting of sanctions on the oil regime and perhaps more American investment, Chevron is there and will remain there, but more American investment in the Venezuelan oil industry, you could see more Venezuelan exports come into the market, which again would add to the slightly bearish picture that we've been describing in the global oil market in the medium term. Venezuela, remember, sits on some of the world's biggest oil reserves. There is plenty of oil to exploit. It's not happening right now because of the way that the socialist regime has run down the oil industry over the last 2 decades plus, but the potential is certainly there.
Will Kennedy, Tyler Kenda, both of you, thank you so much for being with us. Stephen Auth, still with us from Federated Hermes. Steve, how do you look at the U.S.'s increased involvement in South America when it comes to an investing thesis? Is this a positive thing? Does this lead to more sort of inflow of commodities? Is this a potential catalyst, existential risk that could come into play in 2026?
I don't see it as an existential risk, Lisa. It looks to me like it's more upside than downside. Assuming you can get control of the Venezuelan oil supplies and bring in Western companies to build up, as you just reported on, that's probably good for the U.S. economy and probably good for the global economy, and probably good for the people of Venezuela who've been suffering under this regime. So as nasty as this business is, probably the intermediate. I mean, you said it with your question. The longer-term picture is probably positive, not negative. It seems like there comes some reasonable setup here, I would guess.
Well, Stephen, I think Venezuela is just the tip of the iceberg. But if you want to focus on South America, you can't ignore USMCA, which may very well get trumped by July 1st of next year. And just this weekend, we have the EU-Mercosur deal, right, which Emmanuel Macron might derail. So talk to us about the prospects for Latin America, for Mexico, for Brazil, as we look ahead to the new year.
We think the prospects are actually pretty good, actually. In our emerging markets portfolios, we've added weight to Latin America with the idea that things are probably moving in the right direction. You've got a number of elections next year that probably should shift things even more towards the U.S. and towards better prosperity for the region. I'm not sure what you mean by USMCA, but I guess that the free trade zone will be maybe expanded and improved. That would be where I would think we're heading here.
Right. Well, with USMCA, I'm talking about the U.S.-Mexico-Canada trade deal, $2 trillion trade deal.
Yeah.
But look, you mentioned those elections, and look, I run emerging market fixed income research for Bloomberg Intelligence, Peru, Chile, Brazil. It's right in my wheelhouse. Talk to us about these elections that you're going to see in Brazil specifically. I'm going to be there next week. What are you expecting to come out of Brazil? Do you expect Lula? Do you expect a more populist shift? You mentioned a shift back toward the U.S. What's in store there?
I don't know. Our guys think the shift is probably more back towards the U.S., something a little more back towards the middle. I mean, they've experimented with a pretty far-left regime, and probably your reporting is seeing that, right? I mean, in the polls. So that would probably be positive, wouldn't it? I mean, Brazil is a huge economy.
Yep.
And, bringing them more into a kind of trade zone, if you will, of the West here would be a good thing for the U.S. economy. Another reason to be bullish, I guess,
You step back, a lot of people who've come on the show have said that they want to diversify, and that we're going to be speaking with Jean Beauvais coming up, talking about a diversification barrage and how it's difficult to diversify in the same kind of way, and you have to really shift in regions away from the United States in part. How much are you doing that? Are you saying, look, it is important to diversify away from dollar-denominated assets just in order to benefit from some of these potential developments?
Yeah, Lisa, I just came back from a long trip out to Germany with my PMs and analysts out there, and the upside for European economy next year is a little bit better, but it's nothing like the U.S. And the Europeans don't have the big tech leaders. They've kind of missed the AI revolution. So There's a lot of good companies in Europe. You can make some money there. They're a little bit cheaper than the U.S. companies, but we already gave up a lot of that valuation gap in that big move they had earlier in the year. So what we're doing is we're kind of neutral in our balanced portfolios, EFA, which technically means Europe and Japan. We like Japan a lot, and actually we're heavy there because there's a lot of real restructuring going on in Japan. Japan is early. But where we're really finding value is more on the emerging markets side, because that's the one place where you can get value and you can get tech. Because outside the U.S., the only other really region of the world that is part of the big tech revolution, if you will, is Asia. Taiwan, Korea, China. So, we think that is a way to diversify but still stay in the channel of AI. On the other side, we're still overweight the U.S. because this is the leader of this industrial revolution. So we're not giving up on the U.S. As you know, we have a target 8,600 2 years out. So, we think that'll be driven by earnings.
Yeah, 2026, hold my beer. Welcome to 2027. Stephen Ott, the Federated Hermes, thank you so much for being with us. Merry Christmas. Have a wonderful holiday season. Really
Merry
great
Christmas.
to see you. Coming up next, Elizabeth Economy of the Hoover Institution on the state of trade between the U.S. and China. Plus, Yahira Anand with your morning movers. Frontier Airlines takes off on renewed Spirit merger talks. This is Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's try this melt-up thing again, the Santa Claus rally. Right now, we are seeing futures higher, at least for the moment, led by NASDAQ, led by the tech space. You're seeing a 0.4% gain there. S&P futures up by about 1/3%. Russell 2000 flagging. Is this the beginning of maybe the end of the very brief rotation trade? I understand maybe I'm making a mountain of a molehill, but it is the last full trading week of 2025. When you take a look at 2s, 10s, and 30s, a bid into bonds yesterday as the final interpretation was bearish for the labor market report. Maybe the suggestion that it did open the door to a Fed that could cut rates sooner because of the unexpected jump in the unemployment rate. Today, we take it all back because of oil prices. 350 on the 2-year, up about 2 basis points. A similar move on the 10-year, 4.17%. And that 30-year yield still hovering around 4.85%. We mentioned the crude levels getting down to the lowest going back to February of 2021 to yesterday. Today, we reverse that, take that back with both Brent and WTI traded on the NYMEX up more than 2%. The why comes from Venezuela. We will get to that story in just 1 second. A question of how much some sort of intervention by the U.S. in Venezuelan oil trade could end up being pretty transformative. 3 hours away from the cash open. Here are your morning movers. Yahaira Anna and Yahaira.
Hi, Lisa. We start with Netflix. That stock is up 1.6% as Warner Brothers Discovery gears up to reject Paramount Skydance's takeover bid. That's according to sources. According to the board, the deal with Netflix just makes more sense. It has more certainty, while Paramount Skydance's bid is raising red flags over its financing and adding to the drama. Jared Kushner's Affinity Partners has pulled out of Paramount's bid, just marking another blow to that effort. Meanwhile, we move on to Amazon. Those shares also rising in the pre-market, up 1.7%. On our reporting, the tech giant is in talks to invest at least $10 billion in OpenAI in a deal that could see the ChatGPT maker using Amazon's chips, an area that Amazon has been looking to strengthen. It's also a big win for its cloud division, specifically when it comes to AI computing. And we end on the airlines with some potential consolidation. Frontier Group up nearly 9% now in the pre-market. On our reporting that the airline is back in merger talks with Spirit, highlighting how all the other carriers are feeling the pressure to grow in order to keep up with the big three. And if the deal goes through, it could help ease Spirit's financial struggles, which has gone bankrupt twice in less than 1 year, and it could create the fifth biggest airline in the U.S. Lisa.
Thank you so much, Yahaira. More on airlines in just a bit. On our radar this morning, President Donald Trump ordering a blockade of all sanctioned oil tankers entering or leaving Venezuela, labeling the Maduro regime a, quote, foreign terrorist organization. The president threatening the Armada will only keep growing. Sometimes you get lucky. Damian Sassar focuses on this part of the world. And on a broader level, I'm curious, from your reporting, from your investigations, how much the Venezuelan instability has really been a noose around the neck of a lot of local economies.
Well, I mean, I think you have to look at each economy differently, right? I mean, the migration issues and how that impacts Colombia, right? I mean, Colombia probably isn't too happy about, you know, what Trump is doing in its backyard just next door over the border in Venezuela. But Brazil, French Guiana, a lot of the offshore drillers are quite pleased by the actions that the U.S. is taking here to defend their interests. And so, you know, a lot of this started, and a lot of Venezuela's saber rattling kind of ratcheted up after, you know, Venezuela threatened the French Guiana, you know, kind of offshore drilling platforms. And so a lot of this is kind of coming through to roost. If you look at Petrobras, Pemex, some of the big oil producers, YPF out of Argentina, in Latin America, they've all done rather well, and their bonds are actually priced really, really attractively at current levels. So yeah, as an EM investor, those are places that people are starting to look at again.
Yeah, and we just heard that from Stephen Oth in terms of how this potentially has more upside than downside going forward. Of course, there are legal potentials here as well, and the potential ramifications for other areas that could be saying, okay, how is the U.S. going to be involved with us? I mean, how much is that affecting local elections as well as just general sentiment in the region?
Conflict in Western Africa, protests in the Philippines. I mean, it's everywhere, right? I mean, look at Australia. But, you know, I think what this points to for me is the central bank divergence you're seeing. I mean, we just saw that data overnight from the UK, inflation coming in. You know, the BOE is going to cut tomorrow. We're seeing Mexico this afternoon. They're probably going to cut. We saw Thailand. We saw, who else cut this week? A few others. Oh, Chile. I mean, so, you know, there's this divergence, but I think by and large, the Fed is leading the way, and it's a lot of dovish rhetoric out there.
Yeah, elsewhere in global stories, the U.S. preparing a fresh wave of sanctions on Russia's energy sector should President Putin reject a peace deal with Ukraine. Sources telling us here at Bloomberg the new measures could target Russia's shadow fleet of tankers and couldn't be unveiled this week. It is a benefit that oil prices are coming off such a low place. Doesn't seem to be a lot of concern right now baked into the oil market based on all of this rhetoric.
No, not at all. And I think, look, again, this comes back to much of what we were talking about yesterday, just the territorial rights. Where do we go with Ukraine? You know, I mean, what comes next? And, you know, I think that's really the question that investors are asking here.
What comes next is an address from President Donald Trump. He is set to address the nation from the White House tonight at 9 p.m. Eastern. Press Secretary Carolyn Leavitt saying the president will highlight the year's accomplishments and preview his policy agenda for the year ahead. So watch this space. One thing that has been really strong this year has been discussions around trade. The White House keeping on the pressure on China. Treasury Secretary Scott Bessent telling media the country's $1 trillion trade surplus is unsustainable. Joining us now is Elizabeth Economy, senior fellow at the Hoover Institution and one of the stalwart experts and scholars of the Chinese economy. Elizabeth, thank you so much for being with us. I want to start with your take on the trade war so far this year. Is there a clear winner? Has there been any progress? Has it reshaped the relationship between the U.S. and China?
Sure. Lots of questions wrapped up into that. You know, look, I think the good news is the Busan summit between President Xi and Trump really did establish a new equilibrium between the two countries. It really, you know, we took back some of the moves we'd made on export controls, both sides. That was really important, especially for the United States because of China's hold on the, you know, critical minerals and rare earth elements. We took back the shipping, port dock fees, you know, so, and we took off 10% off the tariffs that we had on China, you know, so from 57 down to 47%. So I think a new equilibrium, but that's not to say that there aren't going to be perturbations to the system. And we've already seen just over the past week with the announcement out of the State Department of Pax Silica, this, you know, new arrangement between the United States and 8 other countries to try to develop really a trusted supply chain from, you know, AI, for the AI semiconductor supply chain, all the way from, you know, investments in Australia in rare earth elements and critical minerals, all the way through the UAE with, you know, providing financing. And then, of course, Taiwan is a special partner to the group because, of course, you know, 90% of the or more of this advanced semiconductors that certainly the U.S. relies on come from Taiwan. So, you know, we took that action, and then the Chinese, you know, put back on some export controls around gallium and germanium and graphite, and put some companies that are involved in this new Pax Silica on their unreliable entities list. And so, you know, there are going to be these kind of tit-for-tat moves. Clearly, you know, the administration is not stopping in terms of what it wants to see in the tech competition space. It's going to do what it wants to do, and China's going to respond in kind. You know, hopefully we don't go into a free fall. We don't end up back at the, you know, 150, 175% tariff level. But I don't think it's going to be smooth sailing.
There has been this bigger question about which economy is stronger and better to withstand some of this volatility. Over the past couple of days, we've gotten data out of China signifying that there has been an ongoing decline, weakening in consumer appetite, this concern about prices that are falling too rapidly. Do you think that this is laying the groundwork for some sort of stimulus to support the economy during this prolonged tit-for-tat?
I mean, look, the Chinese, you know, playbook is basically, you know, more investment. And, you know, over the past couple of years, that investment has moved away from the property sector, which has been in a prolonged slump, to the tech sector. You know, clean tech, legacy semiconductors, the whole array of made in China 2025 technologies, you know, where China wants to dominate, Chinese companies to dominate at home and then become global champions. So that includes new materials and EVs and AI, all these, you know, important cutting edge technologies. That is the playbook, and that is what they've been doing. But I think that's running its course, and local governments have, been building up their, debt. The property sector is still slumping. There's no consumer confidence. The country's done very little to reshape the social welfare net to make people feel confident, right, that they're not going to have to spend their savings on some healthcare emergency or on their children's education. So the pension system is, basically broken in about a third of the provinces. So they have to do more to boost consumer confidence. They've been reluctant to do that. And people are not, and that's why they're not buying. And, as an aside, also the birth rate continues to fall, and birth rate tracks with consumer confidence. So if they want to begin to address their demographic challenges, which are also enormous, they need to do more to address their consumer confidence.
That's right, Elizabeth. Demographic challenges, its real estate crisis is entering its 5th year in a row, yet insiders are calling for a stronger yuan, despite the fact that it's an export-led economy. I mean, I think exports rose above $1 trillion for the first time on record last month. Talk to us about, why are insiders, why is China looking for the yuan to appreciate in 2026?
Well, I think it reflects a policy debate within China, and a stronger yuan would encourage consumers to buy more. It would give China greater credibility on the international stage in terms of saying that its currency should be should become a real reserve currency in the future as it pushes to de-dollarize the global economy. And it would relieve some of the pressure that it's beginning to face from the international community now in terms of all those exports, right? Because it's not just the United States that is calling out China for its, export of its overcapacity and all those, EVs and batteries, et cetera. It's Europe, it's Mexico, for example. It's threatening, I think, 50% tariffs on Chinese goods. So I think China has a problem, again, not only with the United States and some of the advanced economies, but also with middle income and increasingly emerging economies that are seeing, their markets flooded with these Chinese goods, and their nascent industries are never going to have a chance to compete. So I think those would be some of the reasons that the Chinese government might make a move toward appreciating the yuan.
Yeah, I mean, Elizabeth, Chinese equities are up, I think, 1.82% overnight following that successful IPO of MetaX. I think the Chinese equity market's up 16-17% year to date. Talk to us about foreign interest in Chinese equities. I mean, for me, I look at the variable interest entity structure as a put-off, right? I mean, you don't own anything, really. You're owning a holdco in the Caymans. You're not really owning an opco. Talk to us about how an investor, a foreign investor here in the U.S. can get comfortable owning Chinese shares.
Okay, so you're pushing me past what I, actually focus on. So I don't want to be giving investment advice to people. Let me just say, I think, the Chinese stock market, has been compared to a casino, and gambling by, some of China's most prominent economists. So, I would always just say buyer beware. But, I am not in a position to be giving advice in this space.
You are in a position to be giving advice to policymakers who will be listening closely. Elizabeth Economy for the Hoover Institution, thank you so much for being with us. This is one of the key stories that we've been focusing on, just how intertwined are these economies and who is going to win ultimately at a time when investors aren't sure yet. They're voting with their feet on both fronts.
Well, affordability issues in China. I mean, the real estate crisis, it's 5th year in a row. China Vanke, a state-owned developer, is probably going to default this week. I mean, it's just, things are a mess domestically, and the fact that they're going to make exports that much more competitive by trying to appreciate the yuan just doesn't make much sense to me.
If you want some, can check out the economy in the United States, maybe. We're going to discuss that coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. UK inflation slipped to its lowest level in 8 months, with consumer prices rising 3% in November. The drop was driven by falling prices of some foods. The data raising bets the Bank of England will cut interest rates at tomorrow's decision. Meanwhile, the suspect of the mass shooting at Australia's Bondi Beach has been charged with 59 offenses, including 15 counts of murder and 1 count of terrorism. 24-year-old suspect Naveed Akram was given his first hearing at his hospital bedside. 15 people were killed in the attack at the Jewish celebration of Hanukkah, with 1 victim remaining in critical condition. And President Trump reportedly plans to interview Fed Governor Christopher Waller today as a replacement for Fed Chair Jay Powell. According to the Wall Street Journal, the process is fast-moving and meetings may be postponed or canceled. Trump interviewed former Fed Governor Kevin Warsh last week, and he and National Economic Council Director Kevin Hassett are considered the front runners. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. It's a fast-moving process since what, September?
2 Kevins and a Chris.
Yeah, I mean, this is where we are. Up next, mixed signals in the data.
Are you not worried then about the... Oh, I think it should come down. It'd be very unusual for job growth not to keep up with GDP in the long run once we see the revisions.
Veronica Clark of Citigroup joins next. From New York, this is Bloomberg Surveillance. Good morning.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Conan in Paris, and this is Bloomberg.
Right now, we're looking at a market that is seeing slight gains ahead of the open, led by the big tech space, interestingly, especially given some of the skepticism about circular financing, vendor financing. We'll get to the latest deal between OpenAI and Amazon that is being speculated on in a second. NASDAQ futures up 0.4%, S&P futures up 1/3%, and Russell 2000 lagging behind. It had been leading. Now we're up about 0.25%. When you take a look at the bond space, any message from the labor market that was anything other than positive, sanguine on the U.S. economy has been shaken off, and right now you are seeing yields inflecting higher. Perhaps this is due to what we're seeing in the crude space, but the 30-year yields, 4.85%. It has been around this level, up almost 4 basis points, on the front end even up 2 basis points, back to close to that 351 mark. A question of how do you interpret a labor market that does seem to be increasing participation, but where the unemployment rate is increasing? Under surveillance this morning, mixed signals in the data.
How concerned are you the unemployment rate keeps rising? We saw an uptick in the unemployment rate, but we also saw an uptick a few months in a row of labor force participation. So I think those government workers are out there looking for jobs. And there's an academic literature that suggests that they'll be very successful at it because government workers tend to be very well qualified when they hit the private sector. Are you not worried then about the unemployment? Oh, I think it should come down. It'd be very unusual for job growth not to keep up with GDP in the long run once we see the revisions.
Here's the latest. Traders looking ahead to tomorrow's CPI inflation print following the unemployment rate rising to a 4-year high in November. Veronica Clark of Citigroup writing, the weakening labor market and easing inflationary pressures will lead Fed officials to cut rates in January and March next year with the risk of more cuts. Veronica joins us now. And I should say it is a fired up Veronica Clark from Citigroup, impassioned as we talk about yesterday's labor market report.
Yeah.
We had on Stephen Auth earlier saying that, look, it shows a positive sign. You are seeing markets shake off the chance of a Fed rate cut in January. You vehemently disagree. Why?
Yeah, I absolutely do. I think the Fed is going to take that increase in the unemployment rate much more seriously than bond markets seem to be right now. It does look like a very consistent increase in the unemployment rate now, the last 5 months or so. We already know that 4.4%, that was the number we had before last week's meeting, is not low anymore. 4.6% is certainly not going to be low either.
Some people say the reason why the unemployment rate went up was simply because more people are participating in the labor market, which is a positive thing. You want to bring people into the labor market. Why do you wholeheartedly reject what Kevin Hassett was saying, which is a lot of this has to do with government workers going to look for work in the private sector, and they will find it?
Yeah, we did see the larger government layoffs. That was the people who took those buyout offers. They dropped off of payrolls this month. But that is still people who are entering a very low hiring labor market and are not finding work who were getting pay. It is true that the unemployment rate rose alongside the participation rate rising, but there were a couple things that happened back in the spring. We saw this really large increase in the level of continuing jobless claims. We saw job growth slowing substantially in May, and the unemployment rate never rose because the participation rate fell substantially then. There has been this really big seasonal trend in all of this data that applies to the participation rate also, and we're kind of just coming up to where we should have been all along.
Veronica, talk to me about the dispersion of job growth in the U.S. To me, I look at private job growth. I'm just seeing, private education and healthcare and little else other than that. Talk to us. Is that right? I mean, talk to us about what is in store for the U.S. economy if those are the only segments of the market that are growing here.
Right. It was an interesting report in that, we certainly see that consistent strength in health and education. That's been the case for a while now. It is a really precarious place to be. You don't want all of, hiring, all of job growth to come from just one sector. There was some strength in construction, which maybe that has to do with also these seasonal adjustment issues. If anything, housing construction has been falling for about 2 years now. You would think that there's downside risk there. And if job growth is just increasingly narrow, that's not a very comfortable place to be.
Well, let's take this through the FOMC, right? The dispersion of the dot plot, you've mentioned that in your work previously. Do you expect that to persist into the new year? Do you expect that Fed FOMC members are going to generate more cohesion around the data? They're going to come to terms with where we are as an economy?
Yeah, I think over time we will. There's certainly that disagreement still. We will in a couple weeks. We're back on schedule. We'll get the December employment report before that January FOMC meeting. I do think the unemployment rate will rise again in that reading, 4.7%. Maybe people take that a bit more seriously. It shouldn't have maybe measurement issues related to the lack of data collections. It's going to take more months of data on the inflation side, I think, unfortunately, to convince the Fed hawks that you shouldn't be as concerned. But I think they'll have that even maybe by the March meeting. I think we'll see more slowing in services prices by then.
Are we overstating the Fed's role in this? At a time when we've seen the least rate-sensitive economy in a very long time, one that's driven by artificial intelligence and exogenous factors that potentially are affecting the labor market as much as anything else, how much will an additional 25, 50, even 100 basis points of rate cuts actually do?
Yeah, it might not necessarily do a lot because the cuts that we've seen so far haven't prevented the weakening in the labor market. But I do worry that we're still in a really prolonged cycle, and this is kind of how John Williams was talking about it yesterday, that maybe this is still a rate-sensitive economy. It's just taking a lot longer to be rate-sensitive. We had so much fiscal policy support the last couple years. The slowing in the labor market, the pullback in hiring really did start 2 years ago, 2023. I don't know if that's going to be all AI-related. It could be that rates are restrictive.
If that's the case, why have long-end yields risen? We saw 175 basis points of rate cuts going back to September of 2024. 10-year and 30-year yields are higher today than they were then. We're seeing the 2-year yields basically at the same place. They haven't actually been accommodative. So right now the market is saying,
Yeah.
We're not buying it.
Right.
What's wrong with that?
Which is not a good sign if it is high rates that are restricting activity right now. You definitely have not gotten that easing that the Fed maybe would have wanted. Obviously, long end yields are going to be a function of a lot of other things. We do run very wide fiscal deficits now, and that's certainly part of it. Maybe questions on stickiness to inflation. And yeah, long run, I could imagine that we're not necessarily going back to 2% inflation exactly. We could be running a bit higher than that. But in the next year or so, if the labor market is weakening, I'm not particularly concerned about those inflationary pressures.
Veronica Clark, wonderful to see you. Looking forward to the next time. Veronica Clark of Citigroup. I mean, to me, this is sort of the conflict, right? Nobody's thinking that there's going to be any sort of downturn, any sort of recession. You're seeing that priced into bonds. You're seeing that priced into stocks. At the same time, real weakness in the labor market.
When you're talking about term premium, Lisa, and you're right to be talking about it, because what will it take for an investor, an institutional investor, to move out along the curve, right? I mean, this is something that in emerging markets, we talk about all the time. Most emerging markets, you go past the 2-year, there's very little liquidity in 5s, 10s. I mean, there's no 30-year in some of these markets. But here in the U.S., the fact that we're dealing with this, and not just the U.S., in all developed markets, that we're coping with this steepening of the curve, especially 10s, 30s, it's a real issue.
Yeah, although you just hear Bob Michael in my head saying there's so much cash out there, and at a certain point, people want to get more than 3% on their cash holdings.
It's just caught in private credit, which is all short duration.
Exactly.
You can't get out.
Which is now $8 trillion in money market funds. We'll be talking about this. What does it mean to diversify? Coming up next, Jean Beauvais of BlackRock, the whole idea of the diversification mirage. Republican Congressman French Hill ahead of that address from President Trump later this evening. Congress, as well as Sheila Kahyaoglu of Jefferies, as we talk about some of the drama going on in the airline space. And Jill Carey-Hall of Bank of America, as Russell 2000 doesn't necessarily have leadership today. It has been gaining the leadership, though, hinging on this bet of the U.S. economy and Fed rate cuts. How feasible is that, given some of the economic data that we've seen so far? Right now in markets, you are seeing a lift that we've been waiting for, 3 straight days of losses, and right now you are seeing gains across the board, led by big tech. People not concerned by circular financing, vendor financing, bring it on, up almost 0.5% on NASDAQ futures. In the bond space, a little bit of a sell-off. Coming up, we'll talk a little bit about oil prices, a little bit about OpenAI and Amazon, and a little bit about CPI. This is Bloomberg Surveillance. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
We're coming to you live from Kuala Lumpur. The whole world
It's here.
APEC Leaders Summit, bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Don't be shocked by these really low job gains. I think they're just kind of standard.
There are a lot of tailwinds supporting the economy for next year.
Yes, inflation is high and it's persistent, but it has been coming down.
It's a little too premature to think that inflation is going to take care of itself.
I'm more focused on CPI because of what it will tell us as to where we're going next.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inflecting higher after 3 straight sessions of losses as big tech reclaims leadership, maybe just briefly. Oil prices surging from 2021 lows as President Trump orders a blockade of sanctioned Venezuelan oil tankers. And the tech money ball keeps on rolling with OpenAI in talks to raise $10 billion from Amazon and use its chips at a time when people are wondering, is this vendor financing or is this something that just feels like big tech players have to be financing themselves?
Well, I look at the OpenAI Disney deal, right? I couldn't understand it at first, but then if you realize what they're really going after, they're going after YouTube, Instagram, TikTok, short-form video content, and they're not paying for it. So it's just interesting to see the approach that Sam Altman and OpenAI are taking to this market, given the fact that it's tough to make money.
We're showing this chart. If you can read it, good luck. Honestly, it is very confusing. It's a visual illustration of exactly all of the connections between NVIDIA, OpenAI, and all of the other tech players. The arrows going in all directions highlights just how circular it is, yeah. And it raises this issue, and this is the reason why people are getting nervous. How much are some of these companies becoming systemically important, right? If OpenAI doesn't deliver on promises that are pretty extreme, how much does that threaten the rest of the universe? There were articles yesterday about how Oracle has pledged more than $200 billion of lease payments over the next 10 years, which is an enormous sum. So you put all this together, this is the reason why there have been these jitters.
Lisa, it's very reminiscent of the late 90s when we saw JDSU and Lucent and Cisco and all these. I mean, like, oh, sure, we'll just pay for you to buy our servers. I mean, it is very reminiscent of that, so I understand the fear in markets.
At the same time, it does promise to be revolutionary, which is the reason why people are betting on the gains and betting on the efficiencies. Right now, what you are seeing in markets is that positivity coming home and this idea that maybe people see certain companies as doing better, as possibly profiting, Amazon in particular, with their latest nascent chip industry, up 0.4% in NASDAQ futures, S&P futures, up now about a similar amount. Russell 2000 lagging behind in the bond space. A bit of a sell-off today on the heels of oil. You are seeing this led by the belly of the curve, by 10-year yields as well as 30-year yields, up now about 3 basis points in both tenors, even 2-year yields, though, rising about 2 basis points. And what you are seeing in that crude space, rising off the lowest levels going back to February of 2021, up now about 2% on both crude, traded on the NYMEX as well as Brent. As we do look to Venezuela, coming up this hour, do not miss this. Jean Bovin of BlackRock as investors await a fresh read on inflation. Republican Congressman French Hill as a blocked healthcare vote draws backlash from GOP moderates. And Shia Kayalu of Jefferies amid renewed merger talks between Spirit and Frontier Airlines. We begin this hour, stocks just pushing a bit higher. Jean Bovin of BlackRock warning of a diversification mirage. I love that phrase. Writing, the importance of the AI theme illustrates why a neutral neutral portfolio allocation doesn't exist when only a handful of mega forces are driving returns. Jean joins us now for more. Wonderful to see you, Jean. Thank you so much for being here.
Great to be here.
So there is this idea that you can diversify away from AI, you can diversify away from the United States. Why is this a mirage?
Well, I mean, it's tempting, and diversification sounds like a good thing to do, prudent and everything. But like in an environment that is driven by only a few mega forces, we think there are 5 AI, I won't name them, demographics and so on. I'm bored of mentioning them. But AI certainly being the mega of the mega forces right now, you cannot really have a neutral position. You cannot be in a halfway house. So either you are with the AI and you buy the market, or you go equally weighted, but you can see an equally weighted performance of the S&P over the last 18 months, and you have massively underperformed. So there's not really like a halfway house and neutral positions. Same thing with U.S. market versus Europe. Earlier this year, it was appealing to say, well, a lot of uncertainty in the U.S., I'm going to try to be prudent and diversify away. That's an active bet against the U.S. It might be the right bet, but you have to do it with conviction.
Well, just to take a step back and to push back a little bit, you could say, just to be extreme about this, that even equal weight is equally leveraged to the AI trade, because right now a lot of people are benefiting that productivity gains in the rest of the 493 will actually be driven by AI adoption, and that will lead, if you do have conviction about this AI trade. So at what point is that actually the diversification away from this big AI mega theme?
I don't think you're pushing back. I think you're amplifying my point, which is exactly right. I think this is, there's no real place to hide. This is the mega force driving everything. If it were to, not pan out to the expectation, there would be, you need a total plan B. It's a different portfolio you need in this environment. So it's not really about hoping you can have passive diversification. I think this is an active management of the environment.
Jean, yesterday we had a lovely conversation with your colleague Mike Pyle, and he was saying exactly the same thing: diversification, 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 but active diversification. He mentioned hedge funds. And my question for you is the similar question I had for him. Investing in hedge funds isn't easy, right? I mean, you're talking about lockups, gates, liquidity, So talk to us a little bit about your approach, how you're advising BlackRock's clients to invest in the alternative asset space.
So I guess the general point is this environment, as we were just saying, requires, you cannot hope to have a passive exposure that's going to deliver as much. So you need to be more active. That can be more nimble in the way you think about your asset allocation. That's the starting point. Reassessing your long-term expectations more rapidly, that's another. But it is an environment that we've seen actually because of it's shaped by structural adjustment, where I think hedge fund types, long-short type strategies and solution have more scope to perform. And actually, we've documented that. You can see that since 2020, that period compared to the previous decade, the top quartile hedge fund managers in the macro space have been able to generate like 5 percentage points more than they were able to. The prior environment was one that was muted by central banks, and they were able to kind of smooth the environment. We don't think that's true anymore, and as a result, these strategies have more scope to deliver. But yeah, it's an active decision. You need to pick the right manager. The skills matter, and it comes with liquidity that needs to be managed and so on.
We keep talking about these mega forces, right? I mean, that's a big thing for BlackRock. The fact that equity market, or for that matter, financial market performance is really tied to one factor, really, and in this case, AI. So I want to ask you about this AI tech spending, CapEx plans for 2026. Do you think it has the potential to crowd out spending from other sectors of the economy?
So we think that the build-out that is actually happening is unprecedented, right? So by 2030, we're talking about 5 to 8 trillion that is taken seriously by the industry. If you take that seriously, that would make it the fastest build-out of CapEx ever. Not like in the last couple of years, like ever. So you have to ask the question, how is this going to get absorbed? We think that the non-AI part of the economy will have to slow down, maybe by 1 percentage point to absorb this. And it's going to be combined with, we think, eventually more inflation. It's significant inflation. It's 1.5 percentage point on top of current inflation that if it does play out. So I don't think it's not going to actually get to that level that is anticipated now. I think the ambitions will be recalibrated, and particularly because energy is going to be a real constraining factor. So it's not on autopilot. So I think that the last thing I would say is that a lot of ambition, but I don't think we're going to see an autopilot just building. There's going to be readjustment, and that's why we remain bullish, because there's still room to adjust quite a bit. We're only 1 trillion into the 5 to 8 trillion at this stage.
What would be a big red flag? What would be a warning sign to you to maybe shift conviction?
So the main thing is this is a story about the world leveraging up. You've talked about the financing a minute ago. It's actually, we see that as a red flag. I think we need technology. Micro is macro. So AI is so big, the financing will be big, and you could, in any environment, there's going to be connection like we're looking at. So leveraging up is going to be one feature of this environment. And the big red flag is it's going to work as long as interest rates and long-term interest rate don't increase very abruptly and significantly. So big red flag for us in 2026 is the interplay between AI and the rate space. And for now, we think the Fed's going to ease further. We might get lucky. So in 2026, we're bullish going into 2026, but it's going to be the risk that we're going to be managing.
Just watching those long end yields in particular, there is this feeling that because of the new tech advancements, there will have to be consolidation, that being bigger is better in order to spend on some of these efficiencies, et cetera. A lot of merger and acquisition news just crossing. Warner Brothers saying that they do oppose the deal coming from Paramount, saying that they do recommend the Netflix deal, saying that they have the Ellison family has not chosen to backstop the Paramount Skydance deal, which actually is a pretty big deal also with the idea that you are seeing the first son pull back from this deal, Jared Kushner, and his fund also pulling out. Warner Brothers deeming the Paramount offer inferior and inadequate, saying that there's no difference in regulatory risk between the two. You are seeing Netflix shares up about 1.6%. I'm not going to ask you to comment on this, John. I know you're not going to. But there is this feeling that mergers and acquisitions has begun to really ramp up, and it will continue to next year. How do you work with that as an investor, actively positioning for the upside for something that seems almost as an inevitability if rates remain where they are?
Yeah, I think that the general story here is that, you can spend a lot of time on the macro, trying to see, taking AI, as we talked about, like whether the spend will eventually be matched by equal revenues and so on. But I think the bigger story is that this is an environment where we don't know who's going to be the winner. There's a lot of new pool of revenues that will be generated. It's not a story simply, I think, just of extrapolating 10 years of tech expanding and tech's going into entertainment. And I think this is more complicated. And we're going to get to a point where the value chain will be across sectors. Like think about new medical procedure. And that's going to be about like big pharmaceutical companies and big tech working together on a value chain. Who's going to actually extract the rent from this is unclear, and that's going to might create actually mergers situation as well. So I think this is an active space where, as we learn about the new revenue pools and who has the market power, we're going to see active opportunities.
Just real quick, what's the 10-year yield that puts the kibosh on all of this activity?
Well, there's no single number, right? So sorry, I'm boring, but like it's going to be about how much growth you get together with that 10-year yield. But I think, we expect rates 10-year to be more closer to 5 than 4. I think the world is more in line with this, with the debt side of things, and then just the compensation that investors, I think, want to have for the duration risk. So I think it's more of a closer to 5 than 4 over the next few years. If we were to break out of this, we would have to go back to the drawing board and reassess. So that gives you a bit of a sense.
Jean Beauvais, thank you so much for being with us. Jean Beauvais of BlackRock here with us in New York. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira and Angie. Yahaira.
Hi, Lisa. As you were discussing, Warner Brothers Discovery is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with Netflix. Warner Brothers board is deeming the Paramount offer inferior and inadequate, and that the terms of the Netflix merger are superior. Meanwhile, President Trump ordered a blockade of sanctioned oil tankers going into and leaving Venezuela. In a post on Truth Social, he said the blockade will only get bigger and designated the Maduro regime as a foreign terrorist organization. The developments have led to a climb in oil prices after they touched nearly 5-year lows. And SpaceX has told its employees the company is entering a regulatory quiet period as it prepares for potential IPO in 2026. Sources telling us here at Bloomberg, employees have been asked to refrain from commenting on, discussing, or otherwise pumping up the company's plans for its public offering in accordance with SEC rules. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, failing to find a healthcare solution.
We worked on it all the way through the weekend, in fact, and in the end, there was not an agreement, wasn't made.
I am pissed for the American people. This is absolute bullshit.
Republican Congressman French Hill joins us next from New York. This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're going to try the rally thing one more time, the Santa Claus rally. Right now, you are seeing a lift to markets, 3 straight trading sessions of declines. Now we are up almost 0.4% on S&P futures. A little bit of dollar strength reasserting itself, 117.16 on the euro-dollar cross. 10-year yields up by 3 basis points right now, almost near that 418 mark. We've been pretty much hovering around that level for a while. And crude up 2.2% on the backs of the plans of the United States to create a blockade around sanctioned Venezuelan oil tankers. More on that coming up in a bit. Now the focus turns to Washington, D.C. as lawmakers try to avoid another government shutdown in January, under surveillance this morning, failing to find a health care solution.
We looked for a way to try to allow for that pressure release valve, and it just was not to be. We worked on it all the way through the weekend, in fact, and in the end, there was not an agreement, wasn't made.
I am pissed for the American people. This is absolute bullshit, and it's absurd. 3/4 of people on Obamacare are in states Donald Trump won. So maybe, just maybe, everybody should look at this and say, how do we actually fix the healthcare system?
Here's the latest. House Speaker Mike Johnson blocking the vote to extend health insurance subsidies that are set to lapse on New Year's Eve, all but guaranteeing higher premiums for millions of Americans. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, it does seem like these premiums will be made obsolete in the next few weeks. Now it goes to the question of a government shutdown in January.
Right, exactly, Lisa. There's a lot on the table. I believe we're now about 5 weeks away from that January 31st deadline when government funding could run out again. And it's probably an understatement to say, as you just heard, that tensions have been rising between House Republican leadership and moderates who are saying that they want to see something done when it comes to these expiring Obamacare premium tax subsidies. An analysis cited by Bloomberg News estimates that more than 20 million Americans could see their premiums spike in the new year. That set a few different policy options on the table. One, moderates, including Mike Lawler, who you just heard from, now have to decide if they want to sign on to what's known as a discharge petition, which could force a vote on extending for 3 years those premium tax subsidies. That has the support of Democrats. But the reality is none of this is expected to get done before Congress adjourns for the new year. So at this point, we haven't even spoken about how the Senate also needs to tackle this issue. So potentially we could see some sort of health care agreement be tacked on to that government funding bill. But at this point, both sides of the aisle and both chambers need to work out their differences. Lisa, of course, as you well know, the backdrop is that affordability has really put Republicans on defense after a slew of election losses last month. And we know that the White House and Republicans in Congress are trying to calibrate their message as we head into the midterms.
Tyler Kendall, thank you so much for that. Joining us now for more, I'm so pleased to say, is Republican Congressman French Hill of Arkansas. Congressman, thank you so much for being with us. I want to start with this disagreement in Congress about even being able to vote on these subsidies. Have you ever seen Congress, Republicans in general, more divided over this issue than they are right now?
Well, Lisa, it's good to be with you. Merry Christmas, Happy Hanukkah to all your viewers and everybody at Bloomberg. Well, first, let's be clear. The tax credits for Obamacare policies are not expiring. The ones that were expanded by Joe Biden during the COVID-19 pandemic are expiring, but that base tax credit that dates back to the beginning of Obamacare for moderate income families with children is still in place. So let's be clear about that, and I'm not sure I agree with the estimate that was cited. What Republicans are trying to do are side with American families across the board and lower premiums across the board, and we've consistently brought bills to the House floor to do that, and we've had Democrats reject them. Last week, the Senate could not find a consensus on this, and that's the definitive place. That was the commitment made during the spending vote. So I think everybody, Democrats, Independents, Republicans, all are suffering from the cost of living burden brought to us by the 9% inflation from the Biden administration. That's coming down, but there's much more work to do. And that includes on passing bills that will actually lower premiums for all Americans across the board.
Congressman Hill, I'm wondering if you could talk to us a little bit about the Housing for 21st Century Act, the act that's expected to streamline housing development, provide incentives for builders. Just exactly what is the act, and how is it going to alleviate the lack of supply in the U.S. housing market?
You bet. Thanks, Damon. It's such a big issue. We have so many people in so many markets that have experienced a run-up in house prices during the past 5 years, and certainly a run-up in mortgage rates due to the Fed fighting the Biden inflation from 21 and 22, and that's really caused a lot of people to not have access to the house that they want. So what we're doing today is we're marking up bills that will reduce regulatory costs of building new houses, improve zoning to encourage better density, more different kinds of units across different cities in the U.S. We're talking about improving opportunities for rural housing development, make it easier for a veteran to get a veteran's loan, and hold HUD accountable on what I think is a deplorable job that they've done over the past decade or so in managing public housing for our neediest citizens across the country who I think have many poor conditions, and HUD is not holding either private landlords or their own housing authorities accountable.
Congressman Hill, U.S. housing affordability, as we know, is at an all-time low. I'm wondering, what is the act or the bill, the proposal, how does it address homeowner expenses, utilities, insurance? I mean, we know that, OpEx has really risen over the past few years. Does it do anything to alleviate the stress on homeowners?
Well, on homeowners, again, 80% of the cost that goes into a house are local zoning, local code decisions, local development fees that are charged on building new houses. If you want to bring down the cost of the mortgage or the cost of property and casualty insurance, you need to confront inflation, which is why I believe the Fed's primary focus is price stability. And we've made progress from the 9% we experienced under Joe Biden's fiscal mismanagement and the Fed's mismanagement coming out of the pandemic. And there's a sustained pressure there to bring down costs, and that will in turn bring down property and casualty insurances. That will bring down the cost of financing. This is a prime goal for the administration. But what this bill focuses on is lowering the cost to manage housing, lower the cost to build housing, and that's something that I think will increase supply, and increased supply will lower prices. We've already seen a modest break in that 5-year high in price appreciation. About 11 of the top 25 markets are seeing some easing off on pricing.
Congressman, one thing that we keep talking about is the affordability crisis, and you've talked about President Biden several times. At what point do you think that President Trump needs to also, though, take some responsibility for the idea that inflation still is above its 2% target? He's talking about keeping rates even lower at the same time that he's been talking about the affordability crisis as a hoax.
Well, look, the affordability crisis is not a hoax. I mean, we see it in the grocery store when we shop. We've seen it in the price level that increased as a result, as I said, of the Biden inflation. That will come down over time. There's work to be done. I think the president's put his attention on doing that by lowering long-term energy prices, by increasing, we're going to vote this week to increase permitting on federal lands, which will open up future development for oil and gas production. That's good. Encouraging production across the country will bring down gas prices over the next few years. And petroleum goes into everything that we make, so that will help bring down prices, as well as some of the things we're tackling on deregulation and financing. I've worked hard in my committee to bring down the cost of financing by making our banks of all sizes more competitive, to have more capital to lend to people who are building houses or wanting to have a mortgage on their first house.
Congressman, just about a minute left, but how much will further Fed rate cuts actually help with the affordability crisis if price stability is, you said, is their preeminent mandate?
Well, look, this is why the Fed has a tough job to determine what the right price level is, what the right level of ample reserves are, and prices have been coming down. They just have gotten sticky right above the Fed's target. So I just simply say that the biggest tax on the American people is inflation, and we've witnessed a 40-year high of it due to the mistakes made by the Fed coming out of the pandemic, and Joe Biden's decision to spend $6 trillion more borrowed in the markets that I think was not the right decision to take, and we got inflation as a result of too many dollars chasing too few goods for those 2 years. But it's coming down. The Fed's been focused on that, and they'll have to make the right decisions about the level of short-term rates. What I think people care about is that 10-year rate, because so much of our mortgage industry is tied to that. And it's why we have to do something about lowering our deficit, because the deficit is what puts that 10-year rate level at risk.
Republican Congressman French Hill, thank you so much for taking the time. Always love getting your thoughts. As we look to the year ahead, coming up next, Sheila Kayalu of Jefferies, Spirit Airlines renews merger talks with Frontier. Plus, Yahira Anand with your morning movers. Warner Brothers Discovery urging investors to reject a hostile takeover bid by Paramount Skydance.